The risks are on the downside, but it's a bit early to look for the real negative numbers in payroll.
You've got labor market conditions down, maybe even negative payroll prints in the next couple of months.
There's seasonal factors weighing on the print. It makes sense for it to be below 100.
We're going to still look quite robust, but we expect that then to come off in the second half.
The unemployment picture is still going to hang in there.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Let's get you to the weekend. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Friday is the US and China position for trade talks.
Can we reach some sort of short-term accommodation with them? That's what they want. I mean, the Chinese are reaching out. They want to meet. They want to talk.
The US says China wants to talk. China says the US wants to talk. For big tech, trade talks can't come soon enough. Apple expecting $900 million in higher costs for this quarter. Amazon bracing for a tougher business climate. Economists hoping tensions don't spill over to the labour market. Looking for another month of solid job gains, preparing for downside risk in the month to come.
Perfectly framed at a time where we are seeing the concepts of a negotiation, the concepts of a coming together of the U.S. and China, concepts of a rally that has already gone on for 8 days. The big question, and this is what you're getting at with the jobs report, how much of the economic damage has been done? Will we see any of it this month? Is it too late to really put the toothpaste back in the tube and avoid some of that damage coming down the road?
One quote from the Chinese Commerce Ministry this morning. The U.S. has recently sent messages to China through relevant parties, hoping to start talks with China. China is currently evaluating this.
This is a very bullish signal, and this is the most honest China has been in terms of where potentially these talks may land. It's very much on brand for the CCP to retaliate, stimulate, and then negotiate. And we are potentially at the start of that negotiating frame when it comes to China. The big question is, does this mean we could potentially see some in-person meeting, a phone call? Is it in earnest a proper thaw to the stalemate?
This is why it's almost impossible to set policy at the Federal Reserve next Wednesday. What do you do? The rules of the games could change. 2 weeks out, 3 weeks out, a month out. The data could change too. They're stuck between a rock and a hard place.
Which is the reason why people say they'll do nothing, and they'll say as little as possible, and they'll try to get off the stage without addressing anything, particularly the political questions that are going to be coming fast and furious as more people in the administration invoke Jay Powell's ghost. So there is this question right now, how quickly will we see the data start to sour? Most people agree we will not see it yet, and because of that, without that hard data really deteriorating, the Fed can stay on hold. The Fed can wait. What the market does with that, what the president does with that, two different things.
The estimate for the payrolls report, 138K. This market up for 8 straight. Looking to make it day 9. Equity futures up by 0.4%. Coming up this hour, in just a moment, we'll catch up with Priya Misra of JPMorgan as China and the US position for trade talks. Tom Forte of Maxim Group on Apple's latest tariff warning, and Sarah House of Wells Fargo as we count you down to the payrolls report. We begin this hour with stocks looking for the first 9-day winning streak in 21 years. Priya Misra of JPMorgan writing, we need credible trade deals soon and some progress on China if we are to reverse the downward slide in the economy. Priya joins us now for more. Priya, good morning.
Morning.
Will we capture that downward slide in the economy in this morning's data?
So I think when we're looking at initial claims, when we're looking at layoff announcements, we haven't yet seen it. And I think, remember, April 2nd was just a month ago. So I think companies have been frozen into sort of this uncertainty. And so, we're thinking, something in that 100 to 150,000. But my issue is that if we get a weaker number, the market's not priced for it. No market is priced for it. The hope is that everybody's frozen in this 90-day period while the trade deals are done. Trade deals are difficult. Even to get an agreement in principle with a lot of them, particularly China, that now is thinking about potentially talking. So I think the economic data, the soft data is telling you it's weaker. I don't know if we see it today. If we see any slowdown, and what I'm going to be watching is the details of that report, because if you look at ADP, now ADP is not a great predictor of payrolls, but their healthcare and education, that was actually pretty weak. That's been the strongest part of the labor market. If you see that downshifting, I think the market's going to get worried that that damage is done. And my concern is the damage is trade, the damage is also uncertainty. The Treasury Secretary has said it's strategic uncertainty. So is that uncertainty going away? I'm not so sure. Hopefully everybody's talking to each other. But to remove uncertainty, we need deals very soon.
Are you confident bonds rally on a bad number?
I do think, yes. I think a couple of weeks ago, we were nervous around this, what was happening with bonds. I think there was this clear deleveraging from the hedge fund community. I think there was also demand for liquidity. Treasuries are still the most liquid asset class in the world. So I think when you get these massive moves in markets, sometimes the treasury market, results in these odd moves. The reason people got nervous is if the end goal of tariffs, and I would argue we still don't know what the end goal of tariffs is, but if it is to remove the trade deficit, the rest of the world doesn't need to hold those treasuries. Is it a negotiating tool? And so I think that concern is why that stock-bond correlation weighed on treasuries. But I think if you get a weak number, it's fairly clear. The Fed reaction function is clear. They'll cut, they may not cut. I don't think they're doing anything next week or even June. But if the economy is slowing, they're going to respond. And I think that asymmetry from the Fed is what is going to bring at least the 0 to 10-year part of the Treasury curve lower in yield. So you get a weak number. I think the Treasury market's going to say that endpoint of 2.9% on Fed funds, after all the cuts, that's way too high. That's close to neutral. The Fed will have to go into accommodative territory.
Over the past month, what we've seen is a distortion in the market that a lot of people are trying to figure out how to reconcile. This idea that short-term bonds are pricing in something of a deterioration in the economic conditions, while risk assets have just signaled the all clear, everything's back to normal, we're all good, let's go to the races. Who's right?
That's a good point. I think the risk asset complex is just happy that there's some hope of deals. And that's what's getting priced in. And I think the risk market is saying that, this damage is not yet done. If we get deals, then we can go back to where we were on Jan 20th. I think the rates market's telling you, the front end of the curve is telling you that there's some slowing. I would argue even the front end of the Treasury curve is not pricing in a recession. The long end is pricing in this fear that there may not be as much demand for treasuries. Plus, what's happening on the tax bill? We haven't been talking much about the tax bill because we haven't got any details. I actually think it's going to take all year for them to try and get this tax bill done. Does that mean much higher deficits? Is that stimulus? So the long end is sort of stuck in terms of supply and demand. And I think those concerns will remain with us. But, back to your question, I think the risk asset complex is a little too optimistic. This hope that if they're talking, they're going to get trade deals right away. What's the effective tariff rate? If the end game is 10% with the rest of the world and, pick some high number, 50, 60% on China, that's a very high effective tariff rate. And that means that companies have to rework supply chains. They're not thinking about CapEx at that point. They're not really hiring people. They're reworking supply chains because you've got the manufacturing superpower of the world that we've tariffed at this high rate. So I think in that scenario, the economy slows down, maybe not recession, but you're looking below trend growth. The Fed, once they feel confident that the unemployment rate's actually rising, they start to cut. So I think the rates market, I would argue, is a little more correct than the risk asset complex that's saying we're going to get the tax deal stimulus, which I would argue there may not be a lot of stimulus, and we're going to get all these trade deals, and we can I love your quote, can you put the toothpaste back in the tube? You really can't.
I stole that from a lot of people who are saying that, but I am curious about going forward, what you would have to see in the deal that we're seeing get crafted in Congress with respect to the budget to make you concerned about treasuries, to make you concerned about supply in a material way, given that there could really be quite a bit of deficit spending.
Right. So I think on the long end, that's really what we're focused on. Apart from, is there any sense of treasury holdings from the rest of the world being used as a negotiating chip? We're looking at that tax front. Now, I would argue, look at the president's budget last night. They're talking about spending cuts. I think the administration understands that there is a constraint. It's a market constraint because interest rates will rise. The Fed really can't control the long end of the curve. You can get them to cut rates, but it's going to be hard for term premium to go down. They understand that, which is why I think trying to get stimulus, I think we'll get TCJA extension. We might get a few other things. What would make me concerned to your question about long end rates going much higher is if you get deficit finance tax cuts. So no spending cuts, and we're going to cut the corporate tax rate. We're going to cut tax on Social Security. If you're going to get clear deficit finance tax cuts, okay, then the long end should be much higher because think about supply demand. We're struggling with the demand side and then supply is going to be a lot higher. I don't think they have the political will to get that done. I don't think that the market will let them get these deficit finance.
Well, why don't you add a record $1 trillion in national security spending that the president is going to float today in his skinny budget? Is there any political will for that? And can the bond market handle that?
I think if it happens without the spending cut, the bond market's going to price it in. And, is that a much higher 10-year rate, which then becomes self-limiting? So the president has said before, the Treasury Secretary and the president, they care about the 10-year. The 10-year is going to not like if it's just without the spending cuts. So I would say I'm looking at the defense increase along with the spending cuts. I actually think it's going to be hard to get both of them done. But if just one happens without the other, and Doge has been a disappointment in terms of how much they've been able to cut, the bond market's going to react. That's going to impact risk assets, it's going to impact the economy, and I think it'll force the administration to come back.
That's on the appropriation side. When it comes to reconciliation, the taxes, what's your base case? Is it just the extension of TCJA, or do you at least get one extra that the president promised on the campaign trail he would deliver?
So I think you can get a couple of extras, small extras. So that would be, maybe tips and overtime. I think we start getting into Social Security, you're looking at $2 trillion over 10 years. That's much harder to do. Now, if we were talking about Medicaid cuts actually going through, I would say maybe you can get a few more things. That's going to be politically very hard to get done. So I don't think you're going to get a whole lot of spending cuts, and that's going to mean it's TCJA plus perhaps tips and overtime.
Bond yield a little bit lower this morning. We're down by a basis point. The 10-year maturity 4.20. Priya Misra of JPMorgan will be sticking with us as we count you down to the payrolls report. 138k is the median estimate in our survey. With an update on stories elsewhere, with your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. China says it's assessing the possibility of trade talks with the U.S. It's the first sign since Donald Trump hiked tariffs last month that negotiations could begin between the two sides. Still, as a condition to negotiations, the ministry asked the U.S. to show sincerity towards China by canceling tariffs on its goods. And you guys were just talking about this. The White House is set to release the first budget proposal of President Trump's second term. The so-called skinny budget will call for $557 billion in non-defense spending. That's a nearly 23% drop from current levels. National security spending, meanwhile, would rise to just over $1 trillion, which is a 13% increase. And Michael Waltz is leaving his post as President Trump's national security advisor after he admitted to adding a journalist to a sensitive Signal group chat. President Trump says he will nominate Waltz to be the next U.S. ambassador to the UN, while Marco Rubio will serve as interim national security advisor while keeping his job as Secretary of State. That's your Bloomberg brief. John?
I think I'm up to speed. Yahara, thank you. More from Yahara later on this hour. Up next on the programme, the US and China position for trade talks.
You'll be seeing the results pretty soon, sooner than most people think, because that's what other countries have been doing to us, just so you understand. They were tariffing the hell out of us, and all we're doing is we're doing it to them, but we're doing it much better.
That conversation up next with Bloomberg's Mike Shepard in just a moment. From New York City this morning on this Payrolls Friday. Good morning. Two names to watch in the pre-market: Amazon, Apple. Amazon bracing for a slowdown of the US economy. That name trading just a little bit softer. Apple, higher tariffs is going to cost the company $900 million this quarter alone. The stock is down by 3%. It could be worse. Equity futures are just about positive. The why, the hopes for talks between the US and China. That's under surveillance this morning. The US and China positioning for trade talks.
You'll be seeing the results pretty soon, sooner than most people think, because that's what other countries have been doing to us, just so you understand. They were tariffing the hell out of us. We couldn't sell cars in Europe. We couldn't sell cars in China. We couldn't sell cars in Japan or anywhere else. We couldn't do anything. And all we're doing is we're doing it to them, but we're doing it much better.
So here's the latest this morning. The US says China wants talks, just as China's Commerce Ministry states it's the US reaching out to them. Both sides looking to position ahead of potential trade negotiations. Bloomberg's Mike Shepard joins us now from Washington, D.C. with more. Shep, the potential for trade talk, just what is going on here between these two nations?
Well, John, we're really seeing the strongest overture yet from Beijing to Washington, that they are receptive to the idea of these negotiations that many on Wall Street and on Main Street, many businesses have been waiting to see get started. We're starting to see the pain felt not only here in the U.S., but in China as well. In China, we saw earlier this week the manufacturing index there shrink for the first time since December 2023, and that's got to be concerning for officials all the way up to President Xi Jinping. So this step we saw overnight from China really suggests that they are just waiting to get that phone call, waiting to have that conversation, that first step toward actually beginning a negotiation. They are looking for a point person who can lead these talks with Donald Trump's blessing. They want to be sure that they are not whipsawed by any cross currents in trade, in the trade policy team with Trump, because there are people of diverging views. You know, Scott Bessent would be much more inclined to do a deal with China than, say, Peter Navarro would be. So this is kind of what we're seeing now. President Donald Trump doesn't have anything on his agenda today except for an event this evening in Mar-a-Lago. So ample time for him to make a phone call. There's been a lot of discussion about whether some sort of conversation might happen at a high level. That will really be the next step. And that would set the stage for actual negotiations to start taking place.
Shep, I want to pick up on your point about Peter Navarro versus, say, Scott Bessent, this idea of a cast of rivals in the cabinet. Who do you think Trump would appoint to potentially run this negotiation?
Well, it's a great question, Annmarie, and it's unclear who would really have his ear. We do see, though, Scott Bessent doing a lot more of the talking these days publicly when it comes to these deals. For instance, he was out there earlier this week talking about South Korea and the kind of progress that they have been making there. Likewise, we heard Jamieson Greer talking as well about, that is the U.S. trade representative, talking about progress perhaps with Japan and India, too. So we are seeing moves made on fronts with those Asian trading partners that are being led by others, or at least led in conversation here by others, especially Scott Bessent. Now, the interesting thing when you talk about those Asian trading partners, that sends a signal to China, too. These are competitors to China with the U.S., and China is looking at this and seeing them making progress with the U.S., and Beijing doesn't want to get left too far behind with respect to its neighbors.
Hey, Shep, appreciate the update. Michael Shepard there down in Washington, D.C. To extend the conversation, Priya Misra of JPMorgan still with us. Priya, let's get to the approach for trade negotiations. The Treasury Secretary, Scott Bessent, spoke yesterday and talked about revisiting the purchase agreements with China back in 2020. A report in the FT in the last 24 hours that Europe might take that approach as well, offering some kind of purchase agreement with the United States. Are you and the team thinking about that just in terms of what a trade deal could look like in the next several months?
We are, absolutely. I think everything's on the table. You know, can they be buying more U.S. products? Can they invest in the U.S.? What can they do with China? Is one of them, I mean, one of the things, it's an important question. What was the aim of the tariffs? Is it to ring-fence China? Is it to have zero trade deficit? I think that's less likely. Is it to have fair trade deal? If it is to ring-fence China, and, you know, we've been calling, I think economists and the market's been calling, and policymakers have been calling for this China rebalancing for a while. How are we getting to it? I think April 2nd was really tricky because we were alienating the whole world. If part of the deal, so to your point, yes, maybe they can buy more U.S. products, but I'm still looking at what's the end point. Is that going to be a 10% tariff still? Is there a chance that that actually goes down to zero, that we can work with the rest of the world? And I think then you can have this sense of that rebalancing being forced onto China. So I would say all of this, Treasury holdings, everything has to be on the table in the trade negotiations, which is why I think it's very hard to get that done quickly. I think that uncertainty is something we have to just get used to.
There's the direct threat of some of our counterparties selling their Treasury holdings, but there also is this feeling that if trade volumes go down, there is less of an incentive for the rest of the world to hold U.S. dollar-denominated assets, including treasuries. And I think it's notable that U.S. government bond funds saw $4.4 billion of outflows in the past week, while European bond funds saw inflows. It highlights this divergence. Do you expect that to continue on the basis that less trade with the U.S. is less of a reason to buy treasuries?
So lots to unpack there. I would say if you have a trade deficit, if you have a high fiscal deficit, which we do, you sort of need that trade deficit to finance. We essentially spend more than we tax. So I think and I don't think that the fiscal deficit is going down. So I think the trade deficit will have to stay. Just economics would argue that the trade deficit's going to remain. I think who it's with is the question. Maybe it's with certain other parties. Maybe we get a purchase agreement and we can reduce that a little bit. But I think your fear is very real, that if the trade deficit is somewhat lower, the rest of the world doesn't need to hold as much treasuries. I think the hope has been that for the treasury market, that there is no alternative. Well, if you're forcing, Europe to actually spend $1 trillion more, they're going to have to borrow. You start to build that alternative. But I would say the starting point was everybody was in the US. I think we're still seeing rebalancing. I think it's too early to say that, this is an en masse shift away from US assets into the rest of the world. At the margin, if people were 80%, 90% invested in the US, I think that this is what we're seeing is that number going down.
On the margins, does that make you unwilling to buy 10-year Treasury yields at 4.2% just because there's going to be an extra term premium? There's going to be an extra cost associated with U.S. Treasuries not necessarily being as desirable or necessary for the rest of the world.
I think that's fair. So I do think term premium is going to be higher. We like curve steepeners. We've been adding to steepeners in this move. But here's the issue. If the economy is slowing down and uncertainty persists with us, I think the economy is going to slow down much more. I would buy 10-year treasuries at 4.20 because if the Fed's cutting rates to 2%, 1%, where's the 10-year? It's not at 4.2, it's much lower, but we have to get used to this higher term premium. It's something the Treasury is going to have to contend with. Our funding cost is going to be higher, particularly as they plan this tax bill. They're going to have to be ready to pay more. So it's that additional cost that will be higher. And I think in the rebound, so hopefully we don't go into a recession and we get these trade deals. A year from now, the economy is much stronger. At that point, that 10-year is going to be much higher. But the here and now is, if the economy is slowing, you're supposed to be long treasuries. I would say even the 10-year, just realizing that curve is going to be steeper.
You keep saying even the 10-year. The 30-year doesn't get a mention. What's happening right at the back end of the curve?
I think there's even more term premium there. So, when you think about term premium, it increases exponentially down the curve. So I don't know about really buying the 30-year. That's just a lot. That's a risk asset for you. And we're de-risking. So I don't love...
You consider the very long bond to be a risk asset?
I do. Given our deficit concerns, given this concern around our treasury holdings on the negotiating table with our trade partners, the flip side of a trade deficit is a capital account surplus. They're buying treasuries because we have a trade deficit with them. So the very long end, I think, is a bit of a risk asset. And duration we saw in April wasn't very helpful. Over the year it has been.
Just quickly, you kept alluding to this, the idea of Treasury holdings being on the negotiating table, maybe a reference in part to Japan, talking about how they're a huge holder of Treasuries, just FYI, just when you want to negotiate with us. Do you realistically think this could be a threat to sell Treasury holdings by counterparts?
I don't think so. I think it's a bit of a nuclear option. But I think this part of negotiation where the U.S. doesn't hold all the cards. The rest of the world needs the American consumer. I get that. But we need their supply as well. And we need them to buy U.S. assets, and we need them to hold the dollar as a reserve currency. So I think this is all part of negotiation. You're going to hear a lot of these headlines. But I think it also tells you Japan wasn't selling treasuries. And now we have data of April to show that central bank treasury holdings did not go down. So that fear in April, I think it was deleveraging, and then the market freaked out a little bit. But I think we're going to hear a lot of these conversations in the next few months as they negotiate.
Priya, it's good to see you, as always. Priya Misra there of JPMorgan Asset Management on this Payrolls Friday. The estimate in our survey, the number we're looking for is 138K. The previous number was 228K. Also looking at a couple of moves in the pre-market. The number one, Apple. Apple lower in the pre-market. Up next on the programme, we'll catch up with Tom Forte of Maxim Group on Apple's new tariff warning. It could cost the company $900 million this quarter alone. As for Amazon bracing for a slowdown in the economy. This is unlike what we saw the day before. These are the two tech names that could be very exposed to the trade story. More broadly, the trade story, some optimism this morning, the potential for talks between the US and China helping equities gain. Equity futures up by 0.4%. From New York City, this is Bloomberg. 8 days of gains on the S&P 500. Equity futures up again. It could be day 9. If we make it day 9, it's the longest daily winning streak going back 21 years. Equity futures on the Nasdaq up by 0.4%. Two very important movers on the Nasdaq we'll get to right now. 3 hours away from the opening bell with your morning movers. Here's Danny Berger. Hey, Danny.
Hey, John. Yeah, we'll kick it off with Apple finally getting some of the contours of the tariff hit that they will take, and that is $900 million in the June quarter. The concern of what that guidance means, sending shares lower by some 3%. Tim Cook really trying to outline in the call, we're trying to diversify our supply chain this quarter. Most of the iPhones will be coming from India. Still, that fear is alive and present about what higher costs mean from them. And China sales were weak, too. So, again, shares down 3%. We also heard from Amazon, one of the other big tech companies, to report earnings. A decent quarter, but a weak guide. Andy Jassy, the CEO, on the call saying, look, the weakness hasn't showed up in orders yet. However, it might be some of the pull forward. It also didn't help from Amazon that AWS slightly underperformed after we saw some pretty solid results coming from Microsoft's cloud unit. So those shares down 1.33%. The final earnings that we got for you this morning after the bell, we heard from Airbnb, the worst performer pre-market on the S&P 500, down 4.7%, seeing softness to come in bookings, a decrease in the growth of which will come from the uncertainty. Again, what we hear time and time again from companies, and we've heard from a lot of airlines and other travel companies, they said that on their platform, the weakness hasn't really shown up yet, but they are seeing things, for example, like Canadians opting to go to Mexico instead of the U.S., saying that the American demand for travel really came from internally. John.
Danny, thank you. Appreciate the update. More from Danny later on this morning. On our radar this morning, one of our top stories, China's Commerce Ministry evaluating the possibility of U.S. trade talks. The ministry urging the U.S. to show sincerity towards China and scrap unilateral tariffs.
This is the clearest signal yet that China is ready to come to the table, ready to at least have a phone call, maybe at the highest levels between Donald Trump and Xi Jinping. What's so important about this statement is where it came from. China's Commerce Ministry. It wasn't some blog post. It wasn't CCTV. This is now an official statement from China that they are currently evaluating this, meaning we're ready to maybe get on the phone. This is the third step in how the CCP operates. Retaliate, stimulate, negotiate. We are at the negotiation stand.
We're thinking about timelines and approach. Let's talk about approach. This from Japan. The finance minister saying the country's U.S. Treasury holdings could be used as leverage in trade talks. This is Japan's chief negotiator, is in Washington for a second round of discussions. So basically what we're hearing, Bramo, is that the bond market might be a tool in all of this.
And Priya Misra just shrugged it off and said, look, the bond market's not responding, so they're not taking this seriously. Nonetheless, what it does show is some of the biggest counterparties to the United States are looking around for their tools to show their leverage and how to get to the table by saying, look, you think you hold all the cards, but we hold your assets and we could liquidate them. This as a threat raises a real question of the interconnectedness of the global economy and how far different parties are willing to go to break it apart.
I think everyone views this and says, look, Japan knows this could really hurt their own economy. The issue is, what if other countries start doing this? What if every other country, most notably China, look at Japan and say, oh, that veiled threat, that actually worked, and they all start doing that? They are hitting at something that this administration cares a lot about, the bond market.
I'm not sure if China would like the currency move that comes with that move. Would China like to do that at this point, given they need a market for some of the things they sell?
You know, China is a much more complicated one. And as you were talking about the idea of a deal, it's unclear what the ultimate goal of such a deal is. You've got China saying that they want a long-standing kind of agreement. And you have, meanwhile, Marco Rubio saying, actually, this is going to be some sort of short-term bridge to gap the uncertainty and the supply disruptions. Whether China is willing to go massively into completely diverging from the U.S., well, we'll have to see what the contours of this kind of negotiation look like.
That's the latest on the trade front. This is the latest down in Washington, D.C. On the personnel front, the president planning to nominate the former National Security Advisor Michael Waltz to be the next U.S. ambassador to the UN. Secretary of State Marco Rubio will serve as interim National Security Advisor while keeping his current role, and his current role has several roles now.
He has a lot of hats. He is Secretary of State. He's interim National Security Advisor. He's acting administrator of U.S. aid. He's also the acting archivist of the United States. Here is the thing when it comes to Marco Rubio. It's the first official since Henry Kissinger to wear both these hats. So it's not actually something we haven't seen before. And at the same time, there is a process underway. The president hasn't decided who he's going to serve as National Security Advisor. When it comes to Mike Waltz, though, I think a lot of people were not surprised because the president has been growing increasingly frustrated after what happened with Signalgate. But this is an individual who served his country, and now he's going to be at the post at the UN. The issue with the UN is he needs to go now in front of the Senate. How complicated are those questions going to be when he goes for his hearing?
It's fair to say there's going to be quite a hearing later on this year in Washington. Equity futures on the S&P, if you're just joining us, welcome to the programme. We're positive by 0.5%, a lift off the back of the prospect of trade talks between the US and China. But two soft notes for you. Amazon one, Apple the other. The latest of the Mag 7 to report earnings. Both companies disappointing investors with warnings on tariffs and trade. Tom Forte of Maxim Group joins us now for more. Tom, when you look at these figures, particularly from Apple overnight, what stands out to you as something to be concerned about?
Yeah, so basically, Jonathan, the analysis here is when it comes to tariffs, how much can a company pass on to its suppliers? How much of the burden will a company have to bear itself? Apple informed us that's $900 million in the June quarter. And then to what extent can they pass off, can they increase prices for a consumer, which we believe Apple can, but they suggested they're still reviewing. So that 900 million data point was very interesting, and it does show that there's a pretty significant impact to the cost for Apple from these tariffs.
Tom, there was an interesting note from Tim Cook, the Apple CEO, to the press. He said, "We don't believe we saw any kind of significant pull ahead due to tariffs in the March quarter." Tom, did he say anything about this quarter, the current quarter, and whether they're seeing any pull forward there?
Yeah, and the answer is no. So I think that this was one, and it really doesn't matter because the tariff situation is the most important thing.
Tom, can I ask you, can I jump in? How does he know? How does he know the difference between the two?
He should have real-time sales data in the current quarter on the iPhones and things of that nature. So yes, he should have a sense.
Well, anecdotally, though, Tom, you're seeing lines at Apple. My parents who really aren't tech savvy are going out and they're making sure they get their desktop and laptop before the tariffs come in place. When will we know there's been a proper pull forward?
Yeah, so I think we'll have a better sense, obviously, when they report the June quarter. The thing that was interesting in the strategy is on a near-term basis, they're basically going to assemble items in China to be sold to the rest of the world, and then in Vietnam and India for U.S. consumers.
How long is that process to basically move everything they can out of China into places like India going to take, Tom?
I think that they illustrated that they're much more nimble, or that their supply chain's a lot more diversified than I had expected, to the extent that they have already positioned themselves where essentially every iPhone in the June quarter sold in the U.S. was assembled in India. So I think that they're further ahead of the curve on diversification and or more nimble than I expected, as reflected in that comment about being able to source iPhones sold in the U.S. out of India for the June quarter.
There's some fundamental issues that Apple's been dealing with for quite a while, Tom, like the competitive landscape in China and declining sales, declining margins there. There also has been the broader question about AI development and how far they're falling behind. Are those issues being masked by the larger existential crisis of some sort of trade barrier or having to shift supply lines? Because it doesn't seem like those issues were cleared up.
They aren't cleared up. So the tariff situation is so significant that we're putting a lot of things on the back burner. We're also thinking about litigation as it pertains to the Epic Games, the implications of Google antitrust for Apple. So there's a lot of risks floating around for Apple, but I do think appropriately right now, investors are hyper-focused on the tariff situation.
That said, I mean, it's a similar story for Amazon, where people are looking at, for example, cloud computing, which was their big profit engine. And it actually came in slightly below expectations at a time where you saw real growth from Microsoft. You saw real growth in Alphabet, Google's parent company. How much is that the existential threat for Amazon at a time where it's clear that any tariffs are going to be eaten in large part through margin?
So absolutely. The pressure on Amazon stock comes, I think, from the potential for a recession and a slowdown in the higher margin businesses, such as cloud computing and advertising. And I think that the numbers were good, not great, and the commentary was good, not great in those regards. Otherwise, I think they have a balancing act where they need to support the sellers, which is 60% of the units sold on the platform, and the buyers to make sure both are healthy in this challenging tariff environment.
They've not had a great week, Tom. They were certainly in the crosshairs down in Washington, D.C. They were exploring, reportedly, breaking out the tariffs from the price of whatever's sold. Now, Tom, I just wonder what the strategy is going to be, how they will communicate with consumers based on the backhand they got earlier this week from the White House.
Yeah. So the good news is that the buy box on Amazon is essentially won by the lowest cost provider to the consumer. So I think they realized that potentially showing the impact of tariffs on their haul-related items, so think of that as where they were trying to really compete against Temu, that was a mistake. But the system is naturally set up to go toward or bias the lower-priced item. So I think that that's another way that the marketplace model somewhat insulates Amazon.
Tom, we saw them back off pretty quickly after the White House came out and said that what they were considering was a hostile political act. Do you think this White House is intimidating players like Amazon?
I think intimidating is a strong word. I think that influencing might be a better word. So I think, again, what we're talking about here is a long-term negotiation between China and the U.S. And at the same time, I think when it comes to Amazon and when it comes to Apple, they do have, the president's ear. So I think that the message I got from Apple is they're, employing kind of a near-term basis while hoping and probably working toward some sort of trade agreement between China and the U.S. So I think influence is a better term than intimidation when it comes to the White House and Amazon and Apple.
Is the real intimidating player here Walmart and the fact that they are going to invest in price or eat it at the margins? Are we seeing that essentially as played out by Amazon, where they're expecting sales to stay about the same, but their operating income to go down pretty significantly in the upcoming quarter? Is that the state of play for retailers that really want to compete right now?
Yeah, so I think Walmart puts more pressure on Target, but I do think you're pointing out that the marketplace model for Walmart is much smaller and much less significant than it is for Amazon. So to the extent that Walmart can lean into its suppliers to a greater extent than Amazon can, and then maintain lower prices, I think it is fair to say that they would have a competitive advantage against Amazon, but I see it as a greater competitive advantage against Target.
Hey, Tom, appreciate the update. As always, Tom Forte there of Maxim Group. How does he know? How does Tim Cook know the difference between front-loading and something else? Andy Jassy of Amazon said we've seen heightened buying in certain categories that may indicate stocking up. Tim Cook said this: we don't believe we saw any kind of significant pull ahead due to tariffs in the March quarter. And then you heard from Tom Forte pushing back that, this is what they're saying go for Apple. I'd love to know how he knows the difference between a genuine purchase of an iPhone and someone worried about the tariffs that are still to come.
The call with Tim Cook reminded me of Fed Chair Jay Powell taking the helm at a press conference for the Federal Reserve, where he wanted to convey as little as possible in terms of his bias as to where things were headed. We have no idea what this is going to mean past June. We have no visibility. Look, we're just conducting our business. We are just a bystander who are doing our job, and not get into anything that could potentially put him in the crosshairs. And that is what that felt like. So how much guidance you can actually get from that, I don't know. I don't know what you do with that, but I can't imagine that you can really say that given what Lori Calvasina and so many other people have said.
Apple is down in the pre-market by about 3%. Equity futures doing OK, up a third of 1% on the Nasdaq. On the S&P, higher by 0.4. With an update on stories elsewhere this morning. With your Bloomberg brief, here's Yahara Hacker. Say, Yahara.
Hi, John. A check on the latest earning. We have Chevron reported better than expected first quarter earnings, but said it will slash buybacks this quarter after oil prices tumbled amid the trade war. Brent crude is down 17% year to date. Tariffs are also expected to increase the cost of steel and other materials needed for production. Those shares are down 2.5%. But its rival Exxon, those shares are up slightly, about 0.3% in early trading after the company beat expectations thanks to higher production from its low-cost projects in Guyana and the Permian Basin. Exxon also bought back nearly $5 billion worth of shares in the first quarter, despite the recent drop in crude prices. It's planning to bring on 10 new projects this year. And TikTok owner ByteDance is being fined $600 million by the European Union for illegally sending user data to China. Ireland's Data Protection Commission, the company's main regulator in Europe, said TikTok infringed the bloc's rulebook with the data transfers and gave it 6 months to suspend all illegal transfers. That's your Bloomberg Brief. John?
Yahara, thank you. Appreciate it. More from Yahara in the next hour. Up next on the program, the pressure building on the Fed to cut.
We are seeing that 2-year rates are now below Fed funds rates. So that's a market signal that they think the Fed should be cutting.
We'll get into that in just a moment with Sarah House of Wells Fargo. She joins us next on this Payrolls Friday. The estimate in our survey here at Bloomberg, we're looking for 138K from New York City. This is Bloomberg. higher for 8 straight on the S&P, a gain over that period of almost 9% on the S&P 500. Equity futures this morning on this payrolls Friday, positive by 0.4%. The big question for this bond market: is it too early to expect some weakness at 8:30 Eastern Time on payrolls? This is what Andrew Honhorst and Citi had to say. The hard data are for the most part holding up, and the front loading of purchases could mean another month of solid data for April. What about May? Anna Wong of Bloomberg Economics. The fallout should be very visible in the May report. Will we see it today, or do you need to wait another month? Yields are lower by a single basis point, the 10-year, 420.58. Under surveillance this morning, pressure building on the Fed to cut.
There's been a substantial decrease in the 10-year since the beginning of the year, but especially since January 20th. And President Trump and I are targeting that point on the curve. We are seeing that 2-year rates are now below Fed funds rates. So that's a market signal that they think the Fed should be cutting.
So here's the latest this morning. No change expected when the Fed meets next week. The why? Investors expect another robust jobs report this morning. Sarah House of Wells Fargo looking for 150,000 jobs to be added, writing, while trade policy abruptly changed throughout the month, we suspect employers resorted to wait-and-see mode. Sarah joins us now for more. Sarah, welcome to the programme. Why is today too soon to expect that weakness, if we see any, to show up?
Thanks, Jonathan. So what really comes down to is just the intersection of the data calendar and timing of the survey week. So the survey week was as early as possible, and it did capture even part of the pre-Liberation Day announcement. And I think just in those, even in that first week and a half or so after that is within the survey week, there was a lot of questions over, does this stick? Is this really happening? And I just don't think employers really changed course that quickly in the wake of that news.
So, Sarah, are there any details underpinning some of the headline number that could shed light on how quickly deterioration really is? Or is this really just going to be almost an irrelevant number as long as it's strong enough to not be relevant?
No, I think you're spot on, Lisa, that the industry details are going to be really important today because they're going to shed some light on, well, are we beginning to see weakness, or are you from these policy changes, or are employers pulling through? So maybe you still get a decent headline number, but is it being driven by more of the services side, which is more immune to what's happening on the trade side? Or do you see areas like manufacturing, transportation, warehousing still holding up, which suggests that these policies aren't quickly adjusting employers' plans for their headcount.
On the flip side, as Priya Misra was saying, it's likely that if it is a weak number, a surprisingly weak number, you'll see a pretty big reaction in markets. I'm just wondering what would get your attention that could be carried out to May, to June, to July, that is an early indicator of just how quickly there could be some sort of economic pain?
Yeah, I think something, sub 100 would really be more of a jarring that, okay, we're starting to see that weakening now. I think, somewhere between 100, 150, like we're looking for. I think, that's in some ways just consistent with that moderating trend in employment that we're expecting as growth does ease, but not necessarily falling out of bed and being an issue for the unemployment rate. So I think that's the sort of number that would capture my attention.
Sarah, if we look at policy in Washington, D.C., and we are to see deals come through in the next, during this 90-day reprieve, is that a signal to corporate America to put the pedal to the metal when it comes to hiring?
I think it's a signal that would be, okay, just hang on as long as you can. Maybe you'll get some relief. I don't think that's necessarily consistent with a reacceleration in hiring. I think there's still some weakness to come in the economy just from all the uncertainty and the stop-start policy. And so I think we're in for a moderation either way. In some ways, it's just the degree of that moderation. But I think that would at least be helpful with, okay, hold the line as long as you can, and seeing that more gradual deceleration in hiring that has to do more with what we're seeing on the supply side of the labor market and not just on the demand side.
I'm glad you mentioned stop policy. The Treasury Secretary has talked about strategic uncertainty. If that lasts, strategic uncertainty for 4 years, what does corporate America do when it comes to hiring overall, writ large?
Yeah, I think you do see a downshift in the pace that would be otherwise. So businesses will adjust, they will go on, but it's going to be at a more tepid or more restrained pace, as I think it does inject more caution into the outlook.
Sarah, help us with Wednesday. The Federal Reserve gets together on Tuesday, presents the outcome of that meeting on Wednesday. We'll get a news conference with Chairman Powell. You heard there from the Treasury Secretary, Scott Bessent, that he's looking at the bond market, the front end of the curve, and he sees a 2-year trading below Fed funds. And he says that's a market signal that they think the Fed should be cutting. Is that how you see things?
So we don't think they should be cutting just yet. And I think just given the information that we've heard from Fed officials is that I think they're going to be waiting to see more until you actually see the weakness in the jobs market. So it's much harder to cut preemptively in this trade environment than it was in 2019, given where inflation is. And so I think while the bond market is signaling that cuts are coming, it doesn't necessarily mean that it's going to be as soon as May or potentially even as soon as June, depending on how you see the hard data in the labor market hang in or not.
Well, give me the timeline for that. Give us an idea of things. We had a question from a Bloomberg subscriber earlier on this hour who was looking at market pricing. But if you look away from market pricing, we've got economists on Wall Street right now at 0 cuts for the year. Mike Gape and Morgan Stanley at 125 basis points of cuts for the year. I can think of Andrew Hoddenhorst over at Citi. Sarah, how do you think about the timeline when we finally cut one way or the other?
Yeah, so we're more on the extreme side. So we're looking for 125 basis point cuts of easing this year. And I think when we're looking at timing, it's when that labor market data starts to break, which while we think we'll get a decent print today, I think we could see more pronounced weakness as soon as the May numbers. And so I think June is certainly a possibility. And even if maybe it ends up being July, I think there's also the possibility, if you are really seeing the labor market weakening, that we're not going in 25 basis point clips. You could see that move to 50 basis points. So I think timing is probably somewhere this summer. And depending on how weak the labor market gets, it could move pretty fast.
Sarah, thank you. Sarah House there of Wells Fargo. All of this, of course, to some extent dependent on trade talks as well. Trade deals are incredibly complex and difficult, and there appears to be just a little bit of tension between Japan and the United States. The latest reporting from Japanese media citing Japanese government officials, the United States reluctant to give Japan auto steel tariff exemptions and also reluctant to exempt Japan from a 10% reciprocal tariff.
This means that this is a very tough negotiation because you recently heard from the Japanese prime minister saying that U.S. auto tariffs are, quote, absolutely unacceptable. So if you see the U.S. being reluctant to give in to something Japan really wants, it means that these negotiations are going to be very intense. At the same time, you have to remember, Japanese main negotiator is in Washington, D.C. right now, and they were hoping for these talks to speed up and then to clinch a deal, Jonathan, by next month.
This is part of the negotiation. I want to be very clear about that, but a lot of people thought that Japan was at the front of the line.
Which highlights how maybe just getting talks isn't enough to really alleviate the pressure right now in markets, that actually some of these tariffs will be wholesale removed. And that's the distinction, I think, that needs to increasingly be made. How much do talks alone soften the field enough to walk back some of the potential damage that was extrapolated out from the tariff regime after April 2nd versus a real tariff regime that people have to grapple with in a new way?
The self-imposed clock, I stress self-imposed clock, is ticking, and we're running out of time. Equity futures on the S&P positive by 0.4%. Up next, Mohamed, El-Erian of Queen's College, Cambridge, Ed Mills of Raymond James, Ajay, Rajadhyaksha of Barclays, and Sarah Wolfe of Morgan Stanley. The second hour of Bloomberg Surveillance. Up next.
It's just very difficult to gauge what the impact of the tariffs is going to be.
You could see a lot of volatility as they try to figure out what sticks.
The aggressiveness of the tariffs on Liberation Day created that change in perception and sentiment.
Markets are delivering a pretty stark warning.
There's clearly hesitation and a pause until we get clarity.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The second hour of Bloomberg Surveillance starts right now on an 8-day winning streak on the S&P 500, the longest of the year so far, and potentially, if we make it day 9, the longest in some 21 years. Equity futures positive by 0.5% on the S&P, a lift this morning off the back of optimism, the potential for trade talks between the US and China. Elsewhere in the equity market, two movers to watch. Meta and Microsoft yesterday, better than expected. Apple and Amazon this morning, worse than expected. Apple down by 3%, Amazon down by 1%. Lisa, they need a trade deal they need a trade deal fast.
Which really consolidates the entire idea, I think, for today, which is this question of, will the data that we've gotten so far reflect the pain from the uncertainty having to do with the tariffs that have been proposed? And then on the flip side, how realistic is a deal to come together in the shape for the next couple of months that can actually undo some of the economic damage that is already in the works?
And it depends what country you're talking about. When it comes from China, clearest signal yet that China is ready to sit down, potentially have a negotiation or the start of a process from the Commerce Ministry directly. So this is from the CCP saying China is currently evaluating this, that the fact that the U.S. recently sent messages to China through relevant parties. At the same time, what did we just hear about from Japan? The U.S. is reluctant to exempt Japan from 10% reciprocal tariffs. The U.S. is reluctant to exempt Japan when it comes to things like steel and aluminum and autos, something that the Prime Minister said that is absolutely unacceptable.
The next up, the data 90 minutes away. Payrolls in our survey, the estimate 138K, the previous number 228, and a chorus on Wall Street of people who believe it is too early to expect to see any potential weakness in these numbers this morning.
So why do they matter? And we're going to spend the next couple of hours trying to figure out why these numbers matter, leading up in the hour and a half ahead of this number, and then afterwards, how much can we read in? Do we understand potentially the hesitance to hire in particular industries? Can we see and extrapolate out any kind of weakness into next month? Or can we just completely shrug this off and say, actually, watch the tea leaves coming out of Washington, D.C., because that is more important?
Downside risk is something we've heard repeatedly going into this print. 8:30 Eastern time. It's just around the corner. Equities at the moment nicely positive, up by 0.5%. We'll see if that sticks. Up next on this program, we'll catch up with Mohamed El-Erian on hopes that China and the US bring down the temperature. Ed Mills of Raymond James with President Trump's budget proposal set to be released, and Sarah Wolfe of Morgan Stanley counting down to the April payrolls report. We begin this hour with stocks high. The S&P 500 looking to post a 9-day winning streak, the first since 2004. Joining us around the table for the next 2 hours, I'm pleased to say, Mohamed El-Erian of Queen's College, Cambridge. Mohamed, good morning.
Good morning, John.
What's your approach to this data this morning at 8:30?
So I think it does matter because it'll tell us what is the momentum of the economy. It's a little bit like when I wake up in the morning and look at my Aura scores. There's a score for resilience. How is your resilience doing? And it will indicate how strong the resilience of the economy is, because resilience is important to absorb shocks. And we will be absorbing the shocks of the tariff announcement, whatever happens next.
So starting points matter. What's your assessment of where we are based on the economic information you've had and the earnings you've heard?
We're slowing. We have a bit of a stagflationary smell around the place. But there's momentum in this economy. This economy is still relatively strong, and we'll see what's ahead.
What's the cutoff for a lack of resilience that makes you more concerned about the amount of time that this economy has before it flips over in the face of ongoing uncertainty?
So you've got to get really granular for the answer to that question. You've got to look at different levels of household income and how strong is their resilience. You've got to look at different level of corporate balance sheet strength and how strong is that. So I think overall it's a resilient economy, but it's not resilience for every element of the economy. That's why the micro data is as important as the macro data. That is why listening, as you know, to corporate calls is so important.
What's been your takeaway so far from corporate calls? We've seen the greatest number of just complete withdrawals from any type of guidance going back to the COVID pandemic. We've heard a real kind of varied view, and we've seen the weakest growth in earnings, the weakest upside surprise since 2019. What's your main takeaway?
My main takeaway is management matters. So I look at McDonald's versus Yum. If you look at Yum, there's absolutely no sign of anything going wrong. If you look at the Taco Bell results, they're strong, they're up 9%. They're a very well-managed company. Look at another company in the same space, McDonald's, and they are down. Compare Airbnb to something else. So what you're starting to get is management really matters in this environment because they have to navigate through a really tricky landscape.
Help us out with that. What do you think is the optimal strategy at the moment to navigate all the volatility down in Washington, the potential for mismanaging inventory, to make sure you get pricing strategy just right? What do you think the right approach is?
It's that wonderful phrase, beta agnostic. Get as beta agnostic as you can to what's happening in the economy. Come here and be able to look at you and say, you know what, John, I look at these things, but when I run my business, I control my outcomes. And certain companies have been able to do this. You know, it's fascinating for me because the stock market now has basically declared peace in the trade war. Mm-hmm. The bond market is saying, whoa, maybe so, but there is damage to deal with. And we're seeing these two contrasting views of what's ahead. Even if you believe in peace in the trade war, you have to deal with the consequences of the last few weeks.
Mohamed, this is similar to what Bank of America's Michael Hartnett said today. He said market players are now wagering on, quote, lower tariffs, lower rates, lower taxes. So are we basically back to square one after Trump won the election in November?
So that is where the stock market is inclined to go. The bond market is not there. The bond market is saying, no, we have to navigate a slowdown ahead.
So what is the bond market looking at besides trade? It's also the taxes. We're going to get a skinny budget from the president. Is it all of that? The fact that the deficit is just too high to deal with what they want to get done?
No, the bond market is basically saying that there are consequences to decisions. So even if you can get excited about the destination, the journey has consequences. And what the bond market is pricing in is the consequences of this journey. And even though there are consequences on both sides, it is more inclined to say, I am worried about economic growth. That is what the bond market is telling you right now. They are worried about the slowdown in the economy.
One thing that you're so good at is the other side of this equation, the inflationary side of the consequence and how potentially sticky that could be. And one thing we've been getting the sense of is that companies are not sure how much they can pass along to consumers, and they're looking to play around with it on the margins, just see what they can achieve. Based on your understandings and your conversations, what are you hearing in terms of the tolerance of accepting price hikes at a time where companies are remaining nimble and have the experience of the pandemic?
So it's the complete opposite of the pandemic. The average company during the pandemic was able to pass on price increases. Why? Because the consumer had money. They had received all sorts of transfers from the government, and they had money. They were able to do it, but at the same time, their business didn't allow them to adjust prices that quickly. They've learned. So today, they would be able to adjust prices by pressing a button. They don't have to change the price on every tag. They don't have the flexibility to change prices, because they've learned, is much higher. But there's uncertainty as to what will the consumer accept. And that's the reason why they're very timid in how they're approaching this. All it will take is a few companies to increase prices and it sticks, and then others will have no choice but to follow. That's what it takes. So you've got to look at this tipping point.
Which is what we saw from Ford, that they're waiting on increasing their prices until they see what their competitors do to figure out what kind of competitive advantage they have. Given this, does it make sense for the Fed to just walk back into the bushes and disappear? Or is it, this idea that Scott Bessent...
That was the
Simpsons meme.
Just making sure.
That was 100%
That's what
I was trying to do. Thank you. Yes, that was Homer Simpson, which somehow I just compared to the Fed chair. Please excuse me, but I am curious.
Good morning, Mr. Powell. There we go.
I apologize, but we all kind of want to be that person sometimes. Or is this really a chance to step up and respond to what we heard from the Treasury Secretary, Scott Bessent?
So let me quote you from an hour ago. And I wrote it down, okay? They want to get off the stage without addressing anything. That's exactly what you said an hour ago, and I think that captures this perfectly. They will do nothing on rates. They will try to navigate a pretty tricky press conference. And their desire, whether they're able to do it or not is a different question, but their desire is to get out of this without making any news.
Do the optics make it more difficult for them? The pressure they're getting from the White House over the past few weeks, does that make them dig in just that little bit more?
I think so. I think Chair Powell has clearly signaled that he wants to be remembered not for the mistake of 21-22. He wants to be remembered for defending the integrity and the independence of the Federal Reserve. That's what he has signaled, and I think he will continue down that path.
The Treasury Secretary did ask a good question. Lisa alluded to it. Let's talk about it. When he came out and said the front end of the curve, the two-year yield, is trading below Fed funds and the market is telling the Fed they should be cutting, how would you respond to that?
I had three reactions. Unusual, politically tricky, and analytically tricky. Unusual because a Treasury Secretary doesn't comment usually on what the Fed should do and what the front end of the curve means for the Fed. So that's really unusual. It's a little bit like the chair of the Fed commenting on the dollar. They don't do that. They respect each other's lane. So this was unusual. Politically risky because they may get cuts for the wrong reasons. Remember the difference between good news cuts and bad news cuts. Right now, the market is pricing in bad news cuts. So you don't want to say the market is right, we have bad news. So that's politically risky. And then analytically, there's lots of things that go into the 2-year. So you can't quite make that jump as cleanly as he has. I understand why he did it, but it is unusual and politically and analytically risky.
Mohamed, a clinic as always. Mohamed's going to be sticking with us. Speaking of cuts, a different kind of cut. Corporate guidance and corporate earnings. So in the last 24 hours, GM cutting its guidance. Harley-Davidson cutting its guidance, pulling its guidance. McDonald's had softer revenue. This is what we just heard from Wendy's, cutting the full-year outlook on the current consumer environment. Lisa, we've now heard that from Wendy's and we've heard that from McDonald's.
At a time when they've highlighted middle and lower income consumers really pulling back. And the reason why sales numbers declined was not because of the actual amount of food that people were ordering. There were fewer people coming in the door at McDonald's. Wendy's seeing something similar. How much does this portend a larger trend, and how much is this the sector of the economy that has been struggling for the past couple of years and is just doing so more so?
We'll stay on top of that. Equity futures more broadly just about holding up by 0.4% with an update on stories elsewhere with your Bloomberg brief. Here's Yahara Hacker. Say, Yahara.
Hi, John. Shares of Apple are lower by 3% in the pre-market. The iPhone maker reported disappointing China sales and warned about the impact of tariffs. CEO Tim Cook says President Trump's levies will add $900 million in costs in the current period. He also said Apple plans to source 19 billion chips from the U.S. this year, a supply chain shift meant to lessen its reliance on China. Meanwhile, Japan's finance minister said the country's holdings of U.S. bonds could be a negotiation card in trade talks with Washington. However, he added, whether or not we use that card is a different decision. Japan's chief negotiator, meanwhile, says he aims to achieve a trade agreement with the U.S. in June. And President Trump has signed an executive order to cut federal funding for NPR and PBS. The president has accused both outlets of producing biased coverage and left-wing propaganda. NPR and PBS are only partly funded by U.S. taxpayers and rely heavily on private donations. That's your Bloomberg Brief. John?
Yahara, thank you. More from Yahara later this hour. Up next on the program, the president's budget.
The progress of the one big, beautiful bill. We love that bill. I won't like it if it doesn't pass. Neither will you. Doesn't pass, your taxes are going to go up 68%.
Up next on the program, Ed Mills of Raymond James alongside Mohamed El-Erian. Your equity market positive by 0.5% on the S&P. It's Payrolls Friday. This is Bloomberg. Mohamed coming out swinging this morning, threatening to break Anne-Marie's mug in the commercial break. Brutal stuff.
Aggressive. These Met fans, Jonathan, they're so aggressive.
What happens over at Citi Field? Is this what you do?
No, but the fact that she has it staring at me with the Yankees.
That's why I'm using it today. I wanted to subconsciously troll you.
Okay, well, it's working.
Calm down, Mohamed. Got a few more hours to get through.
Let's go Mets. Come on.
Okay.
I agree.
Equity futures right now in the S&P up by 0.5%. What a week for economic data. First negative contraction on GDP since 22. Consumer confidence the weakest since May 2020. The ISM, manufacturing, streaking the most in 5 months. We'll get some payrolls data at 8:30 Eastern Time. Under surveillance this morning, the president's budget.
The progress of the one big, beautiful bill. We love that bill. I won't like it if it doesn't pass. Neither will you. Doesn't pass, your taxes are going to go up 68%. These will be the biggest tax cuts in American history, with 100% expensing, which is something that people cannot believe they're getting. We did it in the last one, and we had the most successful economy in my first 4 years that we've ever had in the history of our country.
Here's the latest this morning. President Trump's 2026 budget request set to be released today. The proposal calling for a 23% cut to domestic spending and a 13% hike to defense. Bloomberg's Mike Shepard joins us now from Washington for more. Shep, let's get to this. How important is today on a budget front?
John, today is pretty critical. This is the first step in the painstaking annual spending process. What we're going to see in a few hours is what's called the skinny budget. It's really the outline of the fuller request that he'll be sending to Congress in a couple of weeks. And this is just an outline of the president's priorities, the things that he considers most important and wants Congress to focus on. Now, Congress, of course, has its own set of priorities, and they often diverge and they go their own way when it comes to those spending bills that will be negotiated, haggled over, and may even bring us to the brink of a government shutdown later this year, as we so often see every year. Based on what we know of the requests that we're going to be seeing later today, he's calling for raising defense spending up to $1 trillion, roughly, with some money for the Golden Dome Missile Shield project. We're also looking for money for shipbuilding there, but we're also looking for $163 billion in spending cuts to domestic non-defense programs. And that includes at the Environmental Protection Agency, at the Energy Department, a lot of cuts in areas of renewable energy, of course, to foreign aid, which we've seen telegraphed already so publicly, and to diversity, equity, and inclusion programs as well. The one thing we haven't gotten a signal on yet is what is in store for entitlement programs like Medicaid and Social Security. We'll see what the full version says later today. And then likewise on tariffs, what the expectations for revenue are really from that and how that will affect the economy going forward, what their economic assumptions are as well. So, John, a lot to look forward to in the next few hours when we get this. But keep in mind, it's only a starting point for Congress, and they often will ignore what the president's priorities are.
It's a guideline, or potentially, in the president's own words in the past, concepts of a plan. But already, Mike, as you've said, we already see Congress moving ahead with their own plans, the reconciliation package. How does this all tie together, the skinny budget and the reconciliation plan that Congress is already working on?
Well, they're really two separate processes, but they work very much in tandem here. And here's why. The president is looking to cut taxes by as much as $4.5 trillion based on the latest House version of their bill, tax cut bill, and that would be moved through reconciliation. That's a process that allows them to do it with a simple majority without any Democratic support, and that would get it through both the House and the Senate and then to President Donald Trump's desk. But they have a lot of work to do to make sure it adheres to those reconciliation process guidelines. And the way to do it is use the budget as a blueprint, if you will, as a guide, as a path to find those savings. And the more savings that they can find through the budget and spending process, the more leeway they will have to actually get those tax cuts through. And the president is looking to move fast. Treasury Secretary Scott Bessent has set July 4th as a deadline, and the president is putting pressure on lawmakers to act. They are a little bit wary of trying to meet that deadline. We heard that Senate Majority Leader John Thune express a little bit of reluctance about moving that quickly. And we heard JPMorgan's Priya Misra in the earlier hour note that, look, this is a politically fraught process and an economically fraught one as well. And it's probably going to take all year to get it done.
Hey, Shep, appreciate your input. Thanks for the framing. Mike Shepard there of Bloomberg down in Washington, D.C. Mike mentioned what we heard there from Priya Misra. Priya Misra called the 30-year bond a risk asset. A risk asset. What did you make of that when she said it?
I liked it. I thought it captured well the volatility that the 30-year will face in the face of all these competing influences on it.
Ed Mills joins us now of Raymond James. Ed, welcome to the programme. I want to get your thoughts on some of the fiscal risk down in Washington, D.C. and how you think things are stacking up.
Yeah, John. So I think the number one goal of this budget today is to get all of us to repeat the point that it cuts or proposed to cut $163 billion. When I look at the Hill and they're working on this reconciliation bill, if they do what they want to do, the final tab of this bill is going to be somewhere between $5 and $7 trillion. We're going to have some cuts, and that might bring it down to $3 to $5 trillion. But let's be clear, that's going to be the single most expensive bill in the history of the United States. And so if I'm the president of the United States and I'm asking Republicans to do that, I probably want to create a narrative through DOGE, through this budget, through tariffs, through the Treasury Secretary, that we're trying to cut government spending, that we're trying to get a new revenue source, and with the Treasury Secretary telling everyone they're concerned about the bond market. So this is a political document as much as a budget today.
They'd like to create a narrative, Ed, but does that narrative become reality?
Well, everything in politics, everything in life is compared to what? And so this is where they're also kind of laying this out, Annmarie, where they're saying you have a choice as a congressional Republican. Which one do you want to vote for? The largest tax increase in the United States history or the largest tax cut in the United States history? And if you vote for kind of the largest tax cut, you are supporting the president. And for Republicans, it's increasingly difficult to be opposed to this president. And so, yes, they're creating that narrative, and they're creating a juxtaposition that most Republicans are going to take.
Ed, I totally understand the first level of narrative, but there's a second level of narrative, and that has to do with the composition of the budget, and in particular, the different impact of a significant spending cut and a tax cut. They operate differently. And there is a second narrative that says, you know what, this budget in the short term will tip us closer to a recession. What do you make of that?
Yeah, Mohamed, I think what the narrative I get out of that is that this is an administration who is very clearly focused on cuts on the domestic side of things. And yes, there are fiscal impacts of that. But they're also trying to send the message that they want to increase defense spending. This budget will be the first $1 trillion proposal for annual spending on the defense budget. In the reconciliation bill, they want to add another $150 billion to front end load that. I think what we're seeing is historically in D.C., there's a bit of a balance in discretionary spending between defense and non-defense. And this is a president who's saying, let's skew this more towards defense versus non-defense. How that impacts the ultimate economy to be determined. But I think what Republicans would say is when you add up the kind of domestic R&D tax credit, bonus depreciation, no tax on tips, no tax on Social Security, they would say that's fiscal stimulus and could offset on the kind of private sector what the government might be cutting from this budget.
Ed, appreciate the update, sir. As always, thanks for jumping on. Ed Mills there of Raymond James. The timeline, Lisa, is so aggressive. Independence Day, July 4th, to get all this done.
A lot of people saying virtually impossible given some of the dissent. I'm just struck by the offsets here. The narrative that they're trying to paint, the idea of DOGE cuts and tariff revenues offsetting the increase in spending and whether the bond market's going to buy that, I guess we'll see.
When it comes to the timeline, too, the real date is the X date, when the Treasury comes out and says this, we're going to run out of money because they are including the debt ceiling in reconciliation. They have no choice. They have to get this done before that date, and it's not going to be July 4th.
The bond market just about unmoved in the face of all of this. The 10-year back down to 420, 421 this morning, unchanged on the session. The 2-year at the moment at about 369. The payrolls report 1 hour away. Up next on the programme, we'll catch up with Ajay, Rajadhyaksha of Barclays. As tech giants look to boost AI spending, those companies are going to be spending big. Equity futures on the S&P positive by 0.5%. The payrolls report just around the corner. The estimate in our survey, 138K. From New York, this is Bloomberg. The opening about 2 hours away, the jobs report 60 minutes away, and going into it, equity futures up nicely by 0.4%, up nicely over the previous 8 days. 8 days of gains, a move of almost 9%, just absolutely unbelievable, phenomenal. Absolutely phenomenal. With your morning movers, let's cross over to Danny Berger for more. Hey, Danny.
Hey, John. Apple continues to be one of the biggest movers to the downside in the pre-market trade. Those shares down about 3.33%. We got the contours of the tariff hit, about $900 million in the June quarter. At the same time, Tim Cook saying that they would try to get most of their production to come out of India for the current quarter. Still, those fears of weakness sending the stock lower this morning. We're also looking at Chevron. They reported earnings this morning, too. Look, the current quarter, it was really decent. Shares down 2%, though, and you really see the impact of lower oil prices starting to bite. They're going to be reducing their buyback by about 30%. The CFO speaking to Bloomberg saying, look, the oil market has changed, prices have changed, and demand is softening. Hence, we're getting that change to their buyback. Finally, rounding things off with Reddit earnings, a strong set of results for them. Those shares soaring in the pre-market trade, up some 8%. a stronger than expected guidance for the current quarter. Digital advertising looking really good for them. It's been kind of uneven. Snap looked really poor when it came to digital advertising. Meta did better, and Reddit now joining them. So those shares up more than 8%, John.
Danny, thank you. We'll catch up with you a little bit later this morning. Danny Berger there. Three of the movers to look for later on this morning at the opening bow. The big one to look for at 8:30 Eastern time when we get the jobs report. The estimate in our survey, the median at the moment, 138K. On our radar this morning, President Trump looking to cut domestic spending and boost military and national security funding in his 2026 budget. The record $1 trillion defense budget focusing in part on border security and shipbuilding.
So this really speaks to this idea of moving the industrial base back to the United States. It is a skinny bill. There aren't really details in terms of where the cuts are going to come from, and that is going to be key. How realistic are these cuts going to be perceived by a market that is looking for some offset and maybe might look through some of the DOGE and tariff-related income offsets that have been put out there?
The president looking at a different kind of funding this morning. If Harvard was a stock, Annmarie, the latest on Harvard.
The president coming out on Truth Social saying we're going to be taking away Harvard's tax-exempt status. That's what they deserve. What you need to remember, of course, is that universities in the United States, they have a lot of tax exemptions. They basically can file as basically you would a non-governmental organization. This means that they have less to pay out. They can have these huge endowments. And this is something the administration has complained about it. Trump has recently said they act as political entities and doesn't think that they should have this special gateway, basically, of paying less taxes to the U.S. government.
Expect a lot of court cases. They've already been filed. This has already been threatened. This isn't the last word. We've already seen similar types of threats and similar types of responses. Key question is, how do the universities respond? And what it has been is raising money in all sorts of ways through alternative funding to get ahead of any potential cut in the meantime. So people are preparing for this, both from a legal perspective as well as a financial perspective. And there are plenty of different investment firms that are willing to say, hey, okay, I've got a deal for you.
You framed it well. They've punched back. Corporate America said, OK, whatever you say. Harvard's punched back. A very different approach.
Yeah, basically coming out and saying, absolutely not. This is unacceptable. We're going to come back. They also, though, are giving an olive branch with this paper that they put out on anti-Semitism and anti-Islamic sentiment on their campus and said, we need to do better, right? So they came out and they also did take a mea culpa. But at the same time, it seems like this story has not been written yet.
We'll bring you updates on that as we get them, but that's the latest reporting, the latest headline from the president directly. Elsewhere, China assessing the possibility of U.S. trade talks. Its Commerce Ministry saying it has noted the willingness of senior U.S. officials to come to the table. Beijing also urging Washington to show, quote, sincerity.
And we've heard some of that rhetoric before. They really want there to be a point person out of the United States. They also want the president to rein in some of the hot rhetoric that you see from individuals in the cabinet, particularly also the vice president, J.D. Vance. But this is the clearest signal we have seen yet out of Beijing that they are ready to have maybe this rapprochement with the United States when it comes to tariffs. How long does it take? What is the timeline? Who is going to call who? These are all the questions that are left lingering this morning.
Really interested to see this play out for the earnings for big tech. Just two completely different stories. Meta and Microsoft, everything's okay. Apple and Amazon, not so much. Apple warning that tariffs will increase costs this quarter. The tech giant also seeing worse than expected China sales. Amazon citing the impact of Trump's levies, bracing for tougher business conditions.
This is the gap between software and hardware. This is the gap between the AI trade and the idea of all of companies trying to adapt to a new machine learning reality and the rest of the physical world, which is highly dependent on China, both in terms of production as well as sales. Key questions here. Both Amazon and Apple were facing some headwinds ahead of this. How much of that is getting incorporated into Mohamed's point earlier about management versus the actual underlying business? And then there's this other question of how much does this get taken away with the removal of tariffs? When I look at Amazon, this is margin compression that they're pointing to at this point, not necessarily passing along costs. It's just a really interesting moment for both of these companies.
Can I get to one more tech story?
Please.
If you're a gamer and you haven't slept and you're coming up for air and you just wanted to watch a bit of business TV, you might be disappointed. OK, the latest from Grand Theft Auto and Take-Two, that's going to be delayed to 2026 from 2025. That was like the most important game on the planet.
Okay, all I can say, that was so specific. Like, if you were up all night and you decided to tune in to somebody who doesn't like...
Two people care about this. One, if you hold Take-Two.
Okay, fair.
And two, if you're a gamer.
Okay.
I was speaking directly to them.
Yeah, exactly. Are you a gamer, John? I know how you feel about that.
Absolutely
You spend your evenings doing that? I know that you're up all night.
It should be a cut-off, like 25. Unless it's like the football games.
Oh, and then
it's okay? That's acceptable.
Okay,
that's
good.
all right.
That's
Because you're with your friends then. You're together.
Give me a break.
Interacting with the real world just a little bit.
Do you feel judged?
Just a touch. All right. Let's stick with tech. Microsoft, Meta and Amazon all promising to boost AI spend after reporting earnings this week. Ajay Rajadhyaksha of Barclays writing, investor concerns that AI efficiencies could lead to an oversupply in AI infrastructure with implications across sectors. We believe this overlooks the amount of compute needed to operate these models. Ajay joins us now for more. Ajay, good morning. Good to see you.
Likewise.
What are people getting wrong? Let's start there.
I didn't want to bring this up, but the phrase Jevons paradox. The fact is that if something becomes cheaper, you just use a lot more of it. And the thing is, John, this is not new. Technology has always had costs collapsing. Moore's law has held true in the technological world for 50 straight years. That's what's happening again, and demand is going to go up.
This goes back to the conversation off the back of the DeepSeek revelations earlier on this year. Is that where things started to go in the wrong direction, just in terms of the conversation around this thing?
That is correct. So people did start questioning whether you needed, as much computing power as NVIDIA was priced for, as some of the smaller chip manufacturers were priced for, because DeepSeek was significant. There was a point at which you realized you can come up with cheaper, simpler compute models. But what it missed was that democratizes it. More people can use it, more businesses can use it, and overall demand almost always goes up, not down. And you see it in tech spending, in AI spending. They've not taken a beat. They just keep spending and spending.
Which really goes to the heart of the whipsaw that we've seen in tech stocks so far this year, where at the beginning of the year, people were questioning American exceptionalism after a couple months of American exceptionalism. Then all of a sudden, people are saying it's because of big tech. The AI trend is actually way overpriced.
Right.
People have that way wrong. Now we have Microsoft, we have Meta, we have Alphabet. Have we seen a resurgence to this question of how much AI can really drive American exceptionalism?
I think so. I'm not getting those questions anymore, questioning US exceptionalism on the big tech side. The one thing I will say, though, is that the one place where things have changed from 4 months ago is the narrative around China tech has changed. It's not just DeepSeek. Huawei has 5nm and 7nm. BYD has 5-minute charging. Tesla does not have that technology. So there's a narrative building up that there is an alternative. And on the AI side itself, the Chinese are making more strides. They're not as visible because that market is somewhat close to us. But they are making a lot of strides on AI research, and they are still second to the US. But now they are a close second. 4 years ago, I wouldn't have said that.
Ajay, I want to go back to the issue of computing power is not the constraint. In terms of what people were worried about in constraints, from the most to the least, computing power, energy, data, expertise, people.
Yeah.
Okay, expertise, funding.
Sure.
That was the thing.
Yes.
So if you relax computing power,
Yes.
you also relax energy?
No, you don't. And the reason is because even if you relax computing power, the amount of computing power is not going to slow down. And more importantly, the energy demand, I'll give you an example, Mohamed. This seems very weird, but the human brain is extraordinarily energy efficient. It takes 20 watts to do a 10 teraflop computation. It takes 8,000 times that power for NVIDIA's fastest GPUs to do the same computation. And that's what AI is trying to do. It's trying to mimic the human brain. So you're going to have demand for energy go up, up, up. But I agree, critical minerals and human talent are the other two bottlenecks.
But is it a binding constraint, or can we look at not only productivity enhancing shock at the corporate level, but at the level of the economy as a whole?
Historically, it has taken a lot more time than people realize. So, for example, and you'll know this better than me, but the 50s were the golden era of US productivity. But I struggled to come up with a game-changing innovation 10 years before, 20 years before, 30 years before. You had the internal combustion engine, you had electricity, and so on. But what happened in the 50s is, in the 40s, women entered the workplace because of the war, and the GI Bill creates a bunch of educated men. So you finally got to a point where these technologies had been percolating, and now you had a workforce that could take advantage of them. This time should be quicker. But at an economy-wide level, this is not a next year phenomenon. You're right, it'll show up first in corporate earnings. 3 years later, it'll show up at an economy-wide
Actionable ideas. So this is great research, really thoughtful stuff. How do you want to put money to work with all this in mind?
Almost every big technology boom, the United States has been the winner over this century. I don't think that changes, even with all of the changes in narrative. We are all obsessed with the global trade war. I realize that there is an reordering of global trade. But below the surface, this trend is the single most important macro trend over the next 5 years.
Jensen Huang spoke to me on the sidelines before he went in to meet with the president. He said China is formidable now when it comes to chips. And he said they're not behind us. He's like, if they're behind us, they're right behind us.
Absolutely.
Very, very, very close. So why do you think the U.S. is going to win?
The winning part is usually who comes up with the better use cases on a technology. So, for example, the winners from refrigeration were not the refrigeration companies. It was Coca-Cola, believe it or not. Usually you would say an open economy with a lot of startups, with a bigger macro infrastructure is likely to come up. But I'm not prepared to fully bet on one versus the other. The Chinese have made deep strides, and they are pushing at a government-wide level now, yes.
Do you push back against some of the more dire projections for the U.S. economic growth trajectory because of the policy uncertainty and say, you have forgotten about the AI story, you have forgotten about the productivity story that really is going to power a very different backdrop?
Over a 3 to 4 year period, absolutely. But the cyclical for the next 3 to 4 quarters will dominate. I mean, the fact is, if average tariffs go up 25% across the country, and we had 2% to start with, there's no way to look around it. You don't suspend the laws of economics. That is a tax hit on the consumer. And in the near term, the next 2, 3, 4 quarters, that is going to slow down growth. But longer term, this is an absolute tailwind, no question.
Just before you go, payrolls. Do you want to give us a sneak peek of how you're thinking about things?
So the US labor market is about to hit a pretty significant supply shock because the last 3 years, we had a lot of labor coming, some illegal, some temporary humanitarian programs. That's gone to zero. The question in my mind is whether that hits this payroll or not. If that does, payrolls are weaker than markets expect, and the unemployment rate still goes down. And that's something that I don't think markets will like very much. So as long as that doesn't have
to prepare for this summer, do you think?
I don't think so. I think I completely buy the big tech resurgence, but it's astonishing to me, like you said, over the last 8 days, how everyone seems to think that tariffs are completely onto the wayside. The president has taken one left tail risk out of the equation when it comes to the Fed chair, but that's all that's changed. Nothing else.
You're not bullish, are you?
Short term, I'm not. Longer term, I am.
Why longer term?
Because I do think that AI's gains on corporate earnings are going to be quicker than people realize, and eventually that will overpower most other things.
Exceptionalism. Sort of temporary delay. That's what I take away from Barclays this morning.
That's a good way of phrasing it. The idea that in the short term, these tariffs, which are not going away, and I think that he is completely right to say, look, everyone's like saying, yay, it's over. It's not over. It's not as if that's not going to happen. And it's not as if Japan isn't saying that there still is that baseline 10% tariff. But going forward, the productivity, the efficiency that these companies can have is going to be significant.
Ajay, good to see you. As always, thanks for dropping by. It's good to catch up. Ajay Rajadhyaksha there of Barclays. Let's get you an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hacker. So, Yahara.
Hi, John. President Trump said he's taking away Harvard's tax-exempt status in a post on Truth Social. He says, quote, it's what they deserve. Harvard is in the midst of an ongoing fight with the Trump administration, suing for cutting its funding when it refused to make administration-demanded changes to DEI and other policies. Meanwhile, Kohl's fired its CEO for having an undisclosed personal relationship with the vendor and directing millions of dollars of business to her company. He will now reimburse the firm $2.5 million from his signing bonus. The company's chairman, Michael Bender, will serve as interim CEO, and the board is starting a search for a permanent chief executive. And Moet Hennessy plans to shrink its workforce to its 2019 headcount as it faces slow demand and tariff headwinds. The wine and spirits division of LVMH said the reductions will happen through managing natural turnover and not renewing vacant positions. That's your Bloomberg brief. John?
Yahara, thank you. More from Yahara in the next hour. Up next, Biden data.
You probably saw some numbers today. And I have to start off by saying that's Biden. That's not Trump. It's the quarterly numbers. And we came in and I was very against everything that Biden was doing in terms of the economy.
We'll get Sarah Wolfe of Morgan Stanley to react to that, I hope, unless she runs away. From New York City this morning. Good morning. payrolls report just around the corner, 42 minutes away. Equity futures at the moment positive by a third of 1%, up by a quarter on the Nasdaq 100. Under surveillance this morning, Biden data.
You probably saw some numbers today, and I have to start off by saying that's Biden. That's not Trump. It's the quarterly numbers. And we came in and I was very against everything that Biden was doing in terms of the economy. We took over his mess in so many different ways. When you look at the stock market in this case, it says how bad a situation we inherited.
So here's the latest this morning. The White House playing down weak GDP data just ahead of this morning's payrolls report. Sarah Wolfe of Morgan Stanley seeing trouble ahead, writing, we continue to expect a surge in inflation, slowing in employment growth, but little rise in the unemployment rate and a sharp slowing in real spending. Sarah joins us now for more. Sarah, good morning.
Good morning.
Let's get to that. Ultimately, what the president is talking about are his policies eventually showing up in the economic data, which I think is an important question for this morning. Are his policies from April going to show up in the April payrolls report?
I think it's probably too early. We could actually see some upside surprise because there's been a front loading in economic activity ahead of the tariffs, right? So consumer spending accelerated into the end of the quarter, industrial production. And then with the 90-day negotiation period, we're probably seeing some more strength come through in April. So I don't think that we're quite there yet. What we're more likely to see is some of the federal hiring slow down and perhaps some of the ripple effects into federal contractors, and that's where more of the weakness is likely to come through.
What about paralysis? This idea that this survey week was right after April 2nd, was right after Liberation Day, and we heard paralysis from companies that didn't know what to do. How much is that going to factor into just a complete unwillingness to make big decisions like hiring someone?
Well, I think you're making a good point, right? There's two things that are going to impact payrolls, the hiring side and then the layoff side. And right now what we're seeing from businesses is a continued slowdown in the hiring side. And that's where the downside risk, I think, to payrolls comes from. We saw in the JOLTS report that we got earlier this week, job openings came down by quite a bit. So maybe that creates some downside surprise in payrolls. But on the other side, we are not yet seeing the layoffs yet. Businesses are very much in a holding period. They don't know what to do, right? They don't want to lay off their workers and then tariffs get taken off the table and then all of a sudden they don't have workers anymore. But the longer we're in this limbo period, then we will start to see that bleed through of layoffs. And that's where a weak June report, a weak July report is definitely on the table.
Sarah, we tend to focus understandably on the demand side for labor. The guest before you said, don't forget the supply shock. Don't forget what's happening on the supply side. Could we be in a situation whereby it's a negative demand and negative supply shock that results in earnings going up?
100%, especially when we're talking about the immigration story, which has really fallen to the wayside because everybody's focused on tariffs right now. So one of the interesting things that's going to start to happen in the employment reports is that payrolls will slow down, but the unemployment rate may actually move lower because we're losing labor supply as well. If you track border crossings through the southern border, which at their peak were 250 to 350,000 a month, zero. The last few months, we're down to zero. So we're getting that negative labor supply shock already, and that's going to slowly start to show up in the jobs report. Remember, it takes about 6 to 12 months for an immigrant to then become employed, enter the workforce. So now that we're in several months of that slowdown, it could start to ripple through in the participation rate.
Is there a good word to describe that kind of economic situation? Does it start with an
Chaos, confusion.
Stagflation, possibly?
I mean, we're definitely seeing the early signs of stagflation. It puts the Fed in a tremendously difficult position. I mean, we have a Fed meeting coming up shortly, next week, and we're probably going to see a very awkward juggling that Chair Powell is going to have to do, where they're going to be more focused still on the inflation side of their mandate, but try to assure markets that if they need to, they have tools in the toolbox.
Just to build on what John was asking, the previous guest was talking about how the market is not prepared for both a really low employment report as well as an unemployment rate that goes down because of the phenomenon that you're talking about. What does that portend about the pathway ahead for growth, about the pathway ahead for inflation, not just to mention what the Fed is going to do with all that information?
So that's a great question, because even if the unemployment rate is low, if job growth is slowing, that's where the income proxy, right, where labor income comes into play, how many people are actually working, and that's what starts to hit consumer spending. So you could have the unemployment rate go down to 4%, 3.9%, But if we're losing jobs, then you're going to be getting a slowdown in consumer spending. And if you're losing labor supply at the same time, that's going to put upward pressure on wages, especially in some of these very exposed industries like agriculture and construction that are already under a lot of pressure because of incoming tariffs.
You mentioned the Fed meeting on Wednesday. How do you set policy for that?
Very cautiously. I mean, they're going to have to be more focused on the inflation side of their mandate now that inflation expectations have been rising. And then add on to the fact that even if we get tariffs on pause, we already know that businesses are stopping production and stopping shipments. So we're going to get some type of negative supply shock on production that's going to be inflationary as well. And so the Fed, as we know, data dependent. They need to see the data. It's going to be another few months at least until we see a material slowdown in the economic data. So their hands are going to be tied. That's what I think markets are probably underappreciating, is that those 4 cuts that are being priced in look like recession cuts. That doesn't feel very good if they're delivering 4 cuts, but it's because they're being flat-footed and we're in a recession.
Do you think they're going to deliver 4 cuts?
I think the only way they deliver 4 cuts is in the back half of the year. It's very hard for me to see any cuts before September, to be honest. But when they do come, because they're going to be late, we could very easily get 50 basis point increment cuts, and that could get you to 4.
Mohamed said it earlier on, there are good cuts, there are bad cuts. They don't sound like good cuts, do they?
No, it sounds like the average between people who are pricing in a recession and basically people who think that there is not a need to cut at all. This, to me, is one of the biggest dilemmas. If they are late, how much can they actually stave off some of the damage? And if the damage is done, is that accurately being priced into a market that is rallying almost back to where it was on Liberation Day?
Based on how they've set up their reaction function, based on what we've heard from the chairman, they've committed to being late, haven't they?
I mean, essentially, they need to see the hard data roll over because they've dismissed some of the soft data. And politically, how do they say this is going to send us into recession politically? To Mohamed's point, how is that a positive idea that they want to send politically at a time where they are increasingly under fire?
And speaking of politically, how do they cut now when they're getting jawboned by the president and not look political? They are in a really difficult spot and walking a very fine line.
The optics aren't great going into Wednesday, let's put it that way. You know you're going to get the live feed, the live blog from the White House, just as that news conference starts on Wednesday afternoon.
That's the reason why, and I don't think there are any other analogies to Homer Simpson, but I do think that the idea
disappearing
into the bushes is maybe a desirable outcome.
Someone should ask the chairman about that on Wednesday.
Do you want to be Homer Simpson right now?
I want to disappear into a bush. Sarah Wolfe of Morgan Stanley. Sarah, it's good to see you.
Thank you.
Thank you. Sarah mentioned trade. What's going to be happening at the ports? In the next hour, a must-watch conversation, a must-listen. We'll be catching up with the Port of Los Angeles Executive Director, Gene Seroka. He'll be right here in New York City. Look out for that conversation as we count you down to the payrolls report. Reaction from Stephanie Roth of Wolfe Research and Jeff Rosenberg of BlackRock. All of that still to come. The third hour of Bloomberg Surveillance. Up next.
The risks are on the downside, but it's a bit early to look for the real negative numbers in payroll.
You've got labor market conditions down, maybe even negative payroll prints in the next couple of months.
There's seasonal factors weighing on the print. It makes sense for it to be below 100.
We're going to still look quite robust, but we expect that then to come off in the second half.
The unemployment picture is still going to hang in there.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The opening bell 90 minutes away. The third hour of Bloomberg Surveillance starts right now, focused on one thing, the payrolls report, 30 minutes away and just around the corner. Your scores going into that look like this. Equity futures on the S&P, firmer by 1/3%, looking to build on an 8-day winning streak to extend the longest daily winning streak of the year so far to day 9. Day 9, the longest in 21 years. In the bond market, your scores look like this. Yields this morning on a 10-year just about unchanged, 422. At the front end, 370. The number we're looking for later on this morning, this hour, 138K, the median estimate in our survey.
And the key question is, how much does it ultimately matter? Mohamed El-Erian has talked about where we have been from in terms of the momentum in the U.S. economy. A larger question is, how
How quickly can we possibly see the pain that has maybe been implemented on the economy from the tariff announcements? But right now, for a data-dependent Fed, how do we interpret data that is so out of date so as to be potentially irrelevant?
You've got all this potential tension playing out right now. You can feel the tug of war. On the one hand, the potential damage to the economy done by the policies announced in the last month. On the other hand, the potential for deals. And that's what we're talking about this morning, the optimism for talks between the US and China.
And this is actually more important, I think, to the market than the random number generator people will call it when it comes to the jobs number later at 8:30. The fact of the matter is we finally have China saying something officially from the Chinese Commerce Ministry saying the U.S. recently sent us messages. We are evaluating those messages, which means now this sets up the start of this potential negotiation.
Do you put more weight on the talks or more weight on the data later this morning?
Probably the talks, because the data is backward looking and the talks signal what is coming down the pike. That said, is the signal maybe heard a little bit too loudly in terms of what talks signify? It's not going to be necessarily removing all of potential tariffs. And so there's a tug of war here. How much damage is being done as these talks continue and as companies still don't have a compass of exactly what the road ahead looks like?
That sets up this morning. Coming up over the next 60 minutes or so, we'll catch up with Ulrike Hoffmann-Burchardi of UBS, with stocks extending this week's winning streak. Gene Seroka of the Port of Los Angeles as tariffs take a major toll on shipping. And Stephanie Roth of Wolfe Research reacting to this morning's payrolls report. We begin this hour with stocks rising as the US and China look to position for trade talks. Ulrike Hoffmann-Burchardi of UBS writing, "We believe we are past peak uncertainty. The existence of a Trump put reduces the probability of severe downside scenarios." Ulrike joins us now for more. Ulrike, good morning. It's good to see you.
Good to see you,
The
Jonathan.
potential for a deal. What kind of deal are you looking for?
Well, first of all, maybe just to set the stage, the uncertainty tax on companies is still very high. We have seen maybe better than feared Q2 guidance, but when we look at full year guidance for companies, a lot of companies pulled guidance, a lot of companies issued split guidance, very reminiscent of COVID-19. And when we look at policy uncertainty, it is very close to COVID-19 levels. So the trade talks have to result in some material outcomes. That's our view. Ultimately, we think that economic rationality is going to prevail. If you're in a situation where you're running a debt to GDP ratio of over 120%, the one medicine that will cure this is high nominal growth. So ultimately, we think that the trade talks will result in more constructive deals, more selective tariff deals, and also lower effective tariff rates ultimately.
I'm pleased you mentioned the COVID comparison, because one thing we said around the table earlier on this week is that the biggest difference now is that the president already has the vaccine and he can switch the virus on and off whenever he likes. Mm-hmm. He can come out and say deal, exemptions, whatever he likes at any point on social media. Your confidence in the Trump put at the moment, I want to understand how strong that confidence is. If we have a weak number this morning, are you willing to ignore it?
Yeah, I think the market is looking ahead right now. And we turned constructive on US equities, 15% below the peak, for two reasons. One, the Trump put at -20. That was the pivot on the tariff side. And then we also feel that there is a Fed put a little lower than 2018, maybe around 25%. We have now higher inflationary pressures because of tariffs and also the weaker dollar. But ultimately, we see these two puts with different strikes that gave us conviction that the downside is more limited. And then there was such negative sentiment positioning against an upside of more constructive trade negotiations, better than feared Q1 earnings. And then ultimately, I think what we've seen also in the IMF meetings last week, a pivot in narrative now towards deregulation and also tax cuts. So these three upside triggers made us believe that the risk reward at -15% from peak was a pretty good one.
This is a Fed that is committed to being too late, as John was mentioning earlier. And there's a real question about, even though there is a Fed put at some level, it is going to come too late. Pretty much everyone seems to be saying it is too soon to see the real damage in these payrolls reports. So how do you square that kind of idea with this idea that equities are rallying on the idea that there will be a softening in tone, at least from some of the worst case scenarios around trade?
Yeah, look, I mean, I think from here we are now bounced quite a bit off the lows. There might not be a lot of near-term upside, but I think over the next 6 to 12 months, we can see many more positive catalysts emerge. Again, once we have deals, India seems to be very close, as Secretary Bessent said just a few days ago. China more constructive this morning. So as we are seeing deals materialize, I think the market will pivot more towards growth, wanting to see continued growth, strong earnings in the US. We see the AI momentum continuing. So I think we may be over the peak of concerns, and the Fed put the strike may be too low to really matter at that point.
So I want to go back to what you call the Trump put.
Yeah.
So did I hear you correctly that the market believes in the Trump put, but the corporate sector is somewhat more hesitant to believe in the Trump put in a world in which they face not only uncertainty, residual uncertainty, but they also face a Swiss cheese approach to tariff policy. And Swiss cheese tariff landscape, very tricky to navigate for a company. So am I right in saying you're seeing somewhat of an asymmetry between what the market believes in terms of the Trump put and what the corporate sector believes in?
So I think there is a CEO put as well, because I think the more the CEOs comment on the economic potential aftermath of these tariffs, right, the more the urgency of the administration to move. And I think we have seen this with UPS announcing the layoffs. So I think that is a positive thing, that actually the CEOs are flagging the economic risks from the current tariff uncertainty, and will actually, I think, make the administration move more quickly. So yes, there is an asymmetry, but I think the reason that the CEOs are so cautious on the economic environment is a good thing to catalyze ultimate constructive trade deals.
Does it tend to catalyze selective tariffs, your word, selective tariffs, which I translate as Swiss cheese, okay? Certain countries, certain products, etc., and then you have to spend a tremendous amount of time figuring out, are your supply chains consistent with this? Does it encourage what you call selective tariff concession, or does it encourage a general tariff agreement?
I hope it's going to be a combination of the two, but we have seen this in 1819, that ultimately, even with China, it turned out to be very selective, that certain companies were exempted, that certain products were exempted. Because ultimately, if you can't substitute a good in the US, you should not impose high tariffs. So I think that is a constructive economic move. And while it will maybe take a little bit longer, I think if we see signals that we are moving in that direction, that's a very positive thing for US equities.
It's difficult to process all of this. We had a story on the Bloomberg terminal today, which I suggest everyone should go and read, about exemptions without declaring exemptions in China. They're not actually prosecuting what they said they would with regards to tariffs.
And anecdotally, I've been hearing from sources that this is actually happening. The imports will come into China. They will not have that 125% tariff, but China will not say it out loud. They are not being transparent about it, but they're not exactly putting the tariff on. But why? The China Beige Book was out yesterday, and they talked about how manufacturing and factory activity was down in China.
To pair this idea with the asymmetry, there is a feeling in markets that if you're having talks, all of a sudden you could end up with something that is a much more benign outlook for companies. But to Mohamed's point, how do companies make capital expenditure plans? How do companies come up with longer-term buying sprees if they don't have a sense of what the Swiss cheese is going to end up looking like, and if there isn't some sort of cohesive put or strike price that potentially could get engaged with?
You wait, and if you're waiting, are you hiring? And that's the question we're trying to answer in about 20 minutes' time when we get the payrolls report. Ulrike, we've got to leave it there. It's good to see you. Thanks for being here. Ulrike Hoffmann-Burchardi there of UBS. The payrolls report is just around the corner. Equity futures doing okay, up by 0.4%. With an update on stories elsewhere this morning with your Bloomberg brief. Here's Yahara Hackett. Hey, Yahara.
Hi, John. Shares of video game studio Take-Two are plunging 9% in the pre-market after announcing the launch of its flagship upcoming game, Grand Theft Auto 6, will be delayed until next year. The company didn't specify the reason for the delay, but said in a statement it supports its label Rockstar Games' decision to take time to realize its creative vision. Meanwhile, Temu is shifting to a local fulfillment model, only selling goods from local U.S. merchants to American consumers. The move allows the Chinese-owned company to sidestep tariffs and is a change from its original model centered around selling Americans cheap Chinese goods. And in sports, the Knicks are advancing to the second round of the NBA playoffs after beating the Detroit Pistons. Elsewhere, the Clippers and Nuggets are headed for a decisive Game 7 after LA tied up the series. And in hockey, the Toronto Maple Leafs and Vegas Golden Knights and Edmonton Oilers are all heading to the second round of the Stanley Cup playoffs. That's your Bloomberg Brief. John?
Yahara, thank you. Thank you very much. More from Yahara later this hour. Up next on the programme, the Morning Calls Plus. This conversation right here, a must-watch. Gene Seroka of the Port of Los Angeles as shipping traffic plummets. That conversation up next. The opening bounce 1 hour and about 16 minutes away. The payrolls report is just around the corner. That drops in about 10 minutes time. At 8:30 Eastern time, we'll get payrolls. The estimate in our survey, 138K. The equity market looks like this. Your price action positive by 0.4% on the Nasdaq, up by 0.3. That's the market price action. Here are your morning calls with just one stock in focus. It's Apple. First up, Rosenberg downgrading the tech giant to neutral, saying it needs an exciting new product to reinvigorate growth. The stock is down by more than 3%. Your second call from Bank of America, cutting its price target to $235, expecting further deterioration beyond the June quarter. And your third and final call from the team at Jefferies, downgrading Apple to underperform, saying tariff impacts will expand over time and create more earnings downside. That name's softer going into the opening bout. Let's stick with trade. Gene Seroka of the Port of Los Angeles bracing for a plummet in shipping volume next week, writing, quote, with 145% tariffs on goods from China, products cost 2.5 times more than last month. Many large importers here in the US have hit the pause button on cargo coming from China. Gene joins us now for more. Gene, good morning. Good to see you.
Good to see you, John.
Just describe for us, let's take a beat, really frame it for us, how much volume has just dropped off in the last few weeks.
Yeah, about a third of the import volume, which means give or take about 50,000 20-foot equivalent units gone off the arrivals coming in next week.
From next week is when you expect to see this really hit.
That's correct. And that matches up. The announcement's back on April 2nd. Then on April 8th, a little bit of a change on everybody ex-China, Mexico, Canada. And those arrivals are coming at us this weekend.
We'll, of course, dedicate time to your port, but I'm just wondering how you're anticipating this rolls and ripples through the economy from here, how it hits trucking, when this turns up on the shelf. What's the distance, the time from when you see a drop-off in volume and when we, as consumers, see the shortages?
Right. So CEOs are telling me, hit the pause button. Right? I'm not going to import anymore at these kind of prices. Let's wait and see. I don't know if it's going to be 2 hours, 2 days, or 2 weeks till I get some clarity. Then hiring. Off the table for right now. Capital investment, pause. And the retailers are telling me that realistically, with even the 10%, I'm going to have to pass it on to the consumers.
So how much is this really coming from all over? It's not just about China. This is about really global trade coming to a standstill until there is a much greater degree of certainty and a much lower tariff rate than even the baseline that's been put out there.
Yeah, when I was last with you all, Lisa, I said global trade's going to slow, economies will follow, and that's exactly what we're seeing. Back in November, so many of us were wringing our hands about 4% inflation. We've just added 10 percentage points to imports coming out of Southeast Asia for our port, and these unbelievable numbers out of China.
How much are you going to see a real decline in dock workers if this goes on?
Yeah, this is the question. So the trucker hauling 4 or 5 containers today, next week, she probably hauls 2 or 3. The dock workers are no longer going to see overtime and double shifts. They're going to probably work less than a traditional work week, starting right off the bat. Every 4 containers mean a job. So when we start dialing this back, it's less job opportunities.
And what happens if we get a deal?
If we get a deal, it's going to take about a month. Let me walk you through that real quick. About 2 weeks to get the ships repositioned around these major ports, from Qingdao to Shanghai to Xiamen, load up all those containers, and then another 2 weeks to steam across the Pacific to get to us. This is important because now we're talking about spring and summer fashion. So we're kind of at a crux here that we've got to have something pretty quick.
And back to school, which is going to be, I think, very critical when it comes to political pushback for this administration. We have a story out, there's anecdotal reporting as well. We've heard about China quietly starting to exempt about a quarter of U.S. imports. Are any U.S. importers exempting Chinese tariffs? Is there a way to get around the 145%?
Not really. There may be some exceptions, Annmarie, maybe a little bit going north or south of us. But realistically speaking, nobody is out there talking a lot about, hey, I got a better deal coming out of China right now.
The Flexport CEO joined us earlier in the week, and he said ocean freight is down 60% from China. When do we see 100%?
Good question. It depends on how long this goes. We heard the reports overnight through Bloomberg that the folks in China are thinking about talking. What does that mean? Okay, great. But we've got to get a move on here. The other thing is that retailers are saying we've got about 5 to 7 weeks of normal inventory in the country right now. Then we start to see spot shortages if it goes on much beyond this.
So, Gene, you're giving us a really good insight into what's going on. And you said corporates are pressing the pause button on several things, and you listed them. I want to ask you, what does it take to press the play button again? Is it simply good news on the trade negotiation side, or will they want something firmer than that? What is it that it takes the CEO of the different people you talk to press play with confidence?
Yeah, Mohamed, I think it's going to be much more than just talk. It's going to have to be something tangible. And when you're starting at 145% tariff, it's not cutting it in half or cutting it by 2/3. It's getting something realistic, because as was just said by Annmarie, this is going to start impacting some of these important seasonal goods. And if not, China pivoting to other places is not a transactional part of the business.
So you rightly said, and we had the pandemic as a stark reminder, that this is not an on-off light switch, that the ships are in the wrong place, the containers, etc. How long does it take to simply get everything back working in an orderly fashion?
Yeah, it'll take a couple of weeks just on the vessel deployment side, the waterborne architecture of this. And then you got to load up all this product and get it back over here to the U.S. So four weeks in between hitting the play button, as you say, and getting the product to L.A. Then we've got to get it to 15 major hubs.
In your planning, how long to putting the play button? So we have 4 weeks after that. How long?
It really depends. And I can't see that clearly right now, because the talk of getting to the table is still just that. And we're not really seeing any movement from either side. And the China guys are telling me, I had worked there for about 4.5 years, still maintain great business contacts throughout the country. What they're telling me is that factories are really dormant right now, but the government's helping out those workers. So can they wait a little while? I think they can.
The market's treating this as on-off, on-off. The physical world, shipping, what we're talking about right now, it's not the same. It's not the same at all.
What I'm struck by is how much COVID is a corollary and how long it took and the distortions that really were involved. And that people are looking at this as the similar type of disruption, at least when you talk about withdrawals. But I wonder, from a shipping perspective, how much this is actually a similar feeling to what it was in March of 2020 versus something vastly different in terms of both the on-off switch as well as the framework for how to understand global trade.
Gene, what do you think? What would you say to that?
I think the similarity ends with a pretty quick drop-off, but we saw this coming where COVID was a lot different. And then when we figured out about curbside pickup and online buying, and all of a sudden we started that swing in imports again, we just don't know when that's going to happen this time, because it depends on people getting together and talking. So I think the similarities are relatively limited, but now it's what do you do for the worker? What do you do for the planning? And what do you do for these milestones coming up on various inventory and seasonal products?
Tell us about that. What do you do? I assume that overtime just ceases, that ends. What happens to the dock worker?
Right. For us, the dock worker is got to get back out on those terminals and work on the preventative maintenance and repair of equipment, because we know we're going to get a surge again. You've had a pretty hot run for 5 years. This equipment has really been going 24/7. So let's get it back into a state of good repair. Let's get the terminals in good shape, because when that surge comes, we'll be able to see it 40 days before that ship arrives in Los Angeles, giving us plenty of time to plan the skilled workforce, the equipment, and the land. Now is the time to do all that preparation that you normally don't have a chance to do. Take advantage of it.
When they go into these negotiations, what's the rate that gets what you're describing now? Ships back running, dock workers back at the port. What's the rate that'll start to reestablish that?
I think on the 10% tariffs for everybody else, it's got to get lower than that. And on China, you got to start talking about what it really means. The American farmer is getting decimated right now with the retaliatory tariffs. That breadbasket in the Central Valley of California is really hurting. So we've got to talk specifics. But at the same time, protect American jobs, American interests. Rules-based trade are key. But we've got to do it a little bit more strategic.
Well, this is why Brooke Rollins was saying that potentially there's going to be a bailout for farmers, which we saw in the first Trump administration. But Trump promised 10% tariff ring around the United States, 60% on China. What if they end up there?
It's going to change. It's going to change the difference in the world order. I think China goes out and finds other customers. and they said this week in the headlines, other people have money too. This will be very different. And the cost of our products at the store and online goes up. Unequivocally, it's inflationary.
We're less than 7 minutes away from this payrolls report, and it probably won't reflect a lot of what you're talking about. That's a very slow-moving type of ship, literally, coming or not coming toward the United States. But you do talk with these dock workers. You do talk with the truckers. You talk with people who are in the front lines of potentially feeling some of this first. How much are they pulling back? How much are they girding for a whole host of uncertainty? How much have they changed their behavior and seem different to you, just in an anecdotal level?
They're scared. Plain and simple. Not having as much work to do, not having the job opportunities that exist, the warehousing folks included in that group of three, they're really concerned. And these are working class people, good middle class jobs, putting food on the table, kids through college. This is a huge concern. What does it mean next?
Do they also worry about air freight? Do they also worry about companies will start thinking we've got to have a better balance in the way we bring things over?
Yeah, I just had lunch with John Ackerman, who runs LAX and the Van Nuys Airport. His air freight numbers are plummeting. Passenger numbers are of real concern. We've seen the guidance from several of our domestic airlines this week as well.
Has the White House been in touch? Have they spoken to you?
I'm on calls with the USTR. In fact, we'll have another one today. And we've got to advance those conversations. And what I appreciate here with you all every time I come on is amplifying the ground truth of what's happening. Not taking sides. I've got to be apolitical. But now we're starting to see the impact to the workforce. We're going to see the impact on inventory levels, manufacturing parts and components, and these agriculture exports are really, really in play right now.
Gene, appreciate your time.
Good to see you.
Looking forward to catching up again in the future. Gene Seroka there of the Port of Los Angeles, a clinic on what is happening right now. Not an opinion, what is happening right now.
And what's happening is what's not happening, which is those ships are not on the seas coming over here from China, from Europe, from Asia, just more broadly. And that is going to create a problem if it isn't necessarily remedied. There is this question, though, about what this means for the workforce that is most directly affected with this, with respect to docking, with respect to trucking, with respect to railroads.
We've got to talk about a payrolls report in just a moment. It's 5 minutes away. The estimate in our survey, 138K. The previous figure, 228. Tariffs in focus. Policy volatility down in Washington, D.C. Is it too early to expect to see it in these numbers this morning? Your payrolls report just around the corner. Reaction with Stephanie Roth of Wolfe Research, Jeff Rosenberg of BlackRock. The jobs report is 25 seconds away, and going into it, your scores look like this. Equity futures positive by 0.5% on the S&P on an 8-day winning streak coming into Friday, the longest of the year so far. We're looking to make this day 9, and the fate of this market could be in the hands of one man, the President of the United States, and this data. The jobs report just around the corner. In the bond market, the 10-year yield shaping up as follows. Your 10-year, 4.2269. With the payrolls report, here's Mike McKee. Good morning, Mike.
Good morning, John. Well, American exceptionalism continues. 177,000 jobs created last month, 228. That's revised down to 185. So basically, we come out just about even in terms of the month-to-month numbers. The private payrolls were up 167,000. Manufacturing lost 1,000 jobs. The forecast was for 5,000. Unemployment stays at 4.2%. I'll check on the 3-digit number in just a second. Labor force participation ticks up 62.6%, and U6 falls to 7.8 from 7.9%. Average hourly earnings come in a little weaker than anticipated, 0.2% for the month, 3.8%, same as last month for the year over year. And here's an interesting one, 34.3 average weekly hours, 34.2 in the prior couple of months. And if companies were going to be cutting back, they'd usually cut back on hours before they cut back on people. This month, they did neither. Let me check into the rest of it. You know, and John, the whisper number 120, Wall Street was leaning towards a weak report. How are they reacting now?
The risk was a downside surprise, the reality an upside surprise. And Mike, I can tell you, good news is apparently good news. Equity futures session highs up by 0.9% on the S&P 500. On the Russell, we're up by 1.7 in the bond market, unlocking higher yields at the front end of the curve. Yields up by 6 basis points on 2s to 376. On a 10-year, up by 5 to 426.76. In foreign exchange, a touch of dollar strength relative to where we were. So euro dollar rolls over, Lisa, to 113.14.
Yeah, you know, it's interesting to me that the equity market is maybe taking more of a signal because you're seeing yields pop at the front end, but not as much as you would expect if suddenly this took all rate cuts off the table. It's hard to know how much of the strength to extrapolate out, but I think Mohamed nailed it earlier when he said it really gives a sense of how much momentum there is coming in. And to Mike's point, there is still American exceptionalism, at least expressed as it is in April numbers in terms of how much of an upside surprise this
Yeah,
was.
Mohamed nailed it, Lisa, and Priya brought it up. The degree of resilience that this economy has going into what is a policy shock. And for the moment, at least, you're not seeing that weakness in the economic data at the surface level. Mike, I want to bring you back in for the details. What do you see beneath the surface?
Well, it looks at this point like we're seeing an unemployment rate, and this is the one that the Fed really cares about, an unemployment rate that is basically because we're hiring. 436,000 people were hired during the month, according to the household survey, while only 82,000 were listed as unemployed. The labor force rose by 518,000. So a lot of people coming in to look for jobs at a time when we were told companies weren't hiring. So that is kind of interesting. Construction, 11,000 jobs, which is reasonable. This is the time of the year when you would anticipate more construction jobs being added. But there was this fear that we wouldn't be able to find them because of the deportations and border closures. So some interesting news there as well.
So what Mike said just now is really important. It's not just about the demand side, it's also about the supply side. This is a good report all around in terms of demand for labor, supply for labor, and muted earnings growth. So this is something that, as we just heard, confirms residual economic exceptionalism. It says we have momentum going into a difficult period, and the question just is, will this momentum be strong enough to get us through it?
Do you have confidence we'll see a repeat report next month?
No, I don't. I think the world did take a shock, a significant shock, so we're going to see. But it's important, you know, whenever you go into a tricky situation, you want to have momentum. Momentum gives you a certain amount of resilience.
Mike McKee, stay close. I want to bring in Stephanie Roth of Wolfe Research into the conversation. Stephanie, good morning.
Good morning.
Your reaction to this one, please.
It was a strong one. Granted, we had some, downward revisions to the prior month, but the net trend is pretty strong. The challenge is looking forward. There's a pretty big cliff from an economic perspective heading into the next couple of months. And if we don't get a significant downward shift in the tariff rate from China, then things like the strength in transportation and warehousing is going to very much shut off.
If I were a pessimist, not that I am, but if
Not
I
at
were
all.
a pessimist,
No,
if I
why?
wanted to look at the negative side of this, I would say it gives the Fed no excuse to even come close to cutting rates, and that potentially they have no reason to signal that they are concerned about a true weakening in the economy that is politically fraught as well as not represented in the data. How much does that increase the backside of the year and the potential weakness that you could see down the line if the Fed is disinclined to really make any movement?
I think that's right. There's no reason for the Fed to be cutting or signaling that they're going to be cutting anytime soon. At this point, the economy is fine. They have to be reacting to the unemployment rate, which is kind of steady at the 4.2. And they're concerned about the inflation backdrop, but for now, they just have to sit and wait. They have to wait until they see an actual rise in the unemployment rate before they can make notable changes. And at this point, the economy is okay, and consumption has been okay up until this point, so it's just wait and see for the Fed.
On the flip side, to Mohamed's point, and this is the reason why this is such a mentally twisting kind of moment, you could say, well, the economy has a lot of momentum. We're coming into this very strong. We might get something of a hit, but it might be a disinflationary shock, if anything, which might help out the Fed. And then we end up back in the soft landing type of narrative. How much does this give you confidence that we still have that potential, even amid all of the uncertainty?
So base case at this point is the economy can avert a recession, although barely. If policymakers actually start to change their tune a little bit, which we are starting to see out of Washington to some extent, and the headlines around potentially some conversations with China certainly helps. So base case is that they'll change their tune a little bit. If we end up with 10% across the board tariffs and tariffs on China of 50%, maybe 40%, then the economy can be okay this year. You just have a 1% or so shock on the economy. But having the solid momentum heading into this certainly does help.
How much time do they have to change their tune, as you say, to avoid the most difficult economic damage?
We have a couple of weeks.
Weeks, not months.
We have weeks, not months. I was just talking to the guests from the Port of LA just just before this, and they were discussing the amount of time, especially smaller retailers have. They don't have these big warehouses. They have a couple of weeks. Take a bike shop, for example. They have just a couple weeks worth of inventory, and they wait for the next shipment. And if the shipments aren't coming in, it's going to become a problem. They're going to have to just shut down because they'll have 1 or 2 bikes left for sale.
These are the empty shelves that people worry about. If you are just joining us 7 minutes ago, we just got the payrolls report. It came in at 177. The median estimate in our survey was 138. The unemployment rate expected to hold at 4.2%, and it did, 4.2%. They're the two headline numbers we often think about. Mike McKee, you look beyond the headlines. Sum it up for us. If you just missed it, what did you miss?
Well, right now, what I'm seeing is some impacts, it looks like, in the tariff areas or to-be tariffed areas. Computers lost, construction lost 4,000 jobs. Semiconductors lost 1,100. Primary metal jobs were down by 100. Apparel jobs down by 300. And government workers down by 9,000. Leave out the Postal Service, but they got some DOGE cuts too, and you have 8,500. So you are seeing some impacts from the administration's moves already. In terms of the unemployment rate actually rises by a few basis points. The 3 digits is 4.187 from 4.152. So we came very close to getting a 4.3 handle, but it didn't move. And as you're talking about, unless the Fed sees the unemployment rate moving, they're not moving.
The equity bulls getting everything they want this morning, Lisa. A better jobs report, the potential for talks between the US and China, and potentially a 9th consecutive day of gains on the S&P.
I guess I'm trying to understand, if you flip this on its head and you talk about real strength in the economy and you talk about the potential for a deal, are we underestimating the inflationary pressure? Are we underestimating just how much growth there is that potentially is not being accounted for by the Fed or by the rest of the universe? I don't know. I'm just wondering, maybe people were saying there's a difference between the bond market and the stock market, and the bond market's so smart and it's always right. Maybe the stock market was right. And all of a sudden you need to reprice things on the other end.
Pretzels, is that what we're making this morning? Look, let me put it this way. Whether this number was weak or strong, the risk was always that we extrapolated it out. The policy shock that we've had in the last month is so large that the distortions you'll see in the data, not just this month, the month after that, the month after that, just to go back to Gene Seroka again at the Port of LA, he's telling you, he's basically telling you what things look like now and how long it'll take to get things back to normal, even if you strike a deal tomorrow.
Which is the reason why, if you take a look at the 2-year yield, it's almost completely retraced back to where it was before this print, because people are looking through this. They're saying this is not what we're going to experience in the upcoming months.
Jeff Rosenberg of BlackRock jumps into the conversation now. Jeff, welcome to the program. We want your thoughts on where things are, how we're set up, going into the opening bell 50 minutes away.
Yeah, first point here, just agree with Mohamed's take that this is about where is the economy coming into the shock. And this is a good report, and that's important. You've got more resilience when you're coming to a shock from a place of strength. You look through the report across payrolls, across earnings, hourly hours worked. It's all strong. Now, that's the first point. The second point is, unfortunately, it's really less relevant to the go forward, because this is kind of, yes, it's our first hard data, but it's really pre the tariff shock. And as we're discussing that tariff shock and the size and the scope and the amount of exemptions, that's evolving, but none of this data really reflects the impact of the shock, and we'll have to see that data show up. And that's the third point here, is that the Fed, and they're going to have to wait, and they're going to have to wait until they see any kind of impact in terms of a rise in the unemployment rate. And until you see that, you're not going to really see any kind of expectations of Fed intervention. And as the other guest was saying, it's very hard for them to be preemptive and to go to forecast dependence. This is data dependence. And this is lagging data, and so that will be, really one of the last things to show up as we talk about that in months ahead.
Jeff, if I may push you a little bit on what you just said. So how are you navigating all these serious puzzles, soft data versus hard data? What about the sequencing? You hear some people say, yeah, we're going to slow down, but don't worry, there's deregulation, there's tax cuts coming, we're going to bounce right up. There's so many issues right there that people are debating in a very genuine manner. When you put it all together, when you look at the growth rate for the US, the IMF last week took it down from 2.7 to 1.8 for this year. A lot of people thought they would go further down. They will go more towards 1%. Where's BlackRock right now in terms of how all this nets out in terms of growth for the US this year?
You know, we have a very broad, diversified group of investors. So BlackRock as a totality has a lot of different investors with a lot of different points of view. I'll tell you, my point of view on this is that we've had a shock. Is the shock going to be as big as, you know, the immediate market reaction in the post-Liberation Day announcements? No, you see the walk back from that. But the shock has affected outcomes. And the uncertainty about how big that will be, yes, we've probably cut off the tail because the administration's response, the concern about financial markets and the negative reception, the concern from the real economy participants and the real effects that these very initial tariff policies we're having, we're seeing that walked back. However, you still have the damage to be seen, and that means likely some degree of slowdown. And even if the tariff rates are much reduced from the initial proposal, you're still talking about this kind of uncertainty. You know, the Fed brought back into the language a transitory effect on inflation from the one-time tariff increase. The big question will be, in an environment that is much more used to price increases, you know, what are the second order effects on inflation and inflation expectations? As you see that, you know, what should be a one-time effect, is it really a one-time effect? And those will be, you know, the big focus. I think, you know, in our outlook, the vulnerability here is the markets have kind of repriced very quickly any kind of risk premium. You see it in the round trip in equities, you see it in the round trip in high yield spreads. So there's not a lot of margin for safety with respect to market pricing. So for us, that's meant a little bit more of taking the opportunity as the market has kind of moved to very quickly price in a more optimistic take, to take a little more defensive positioning in our portfolio.
Jeff, what does defensive positioning actually look like? What does that mean in today's market?
Yeah, for us, you know, we run a liquid alternative fund that is positioned as a alternative diversifier. So when we're thinking about like our upside downside, we're going to be much more sensitive to downside protection. And so defensiveness means up in quality, for example, in our credit space. It means reducing some of the more equity sensitive areas within the portfolio that have the highest kind of beta, highest market reaction to economic sensitivity, to the potential that tariffs actually end up leading to a much more adverse outcome for the economy. And it means on the duration side, on the interest rate side, because the flip side of the tariff piece for growth is, as I was just talking about, the kind of inflation and inflation uncertainty. And that leads to a very different kind of bond market reaction where you could have a twist steepening where, you know, if the Fed preferences growth over inflation, in a stagflationary shock, you may have the back end, longer maturity rates not doing what you expect them to do. And so that means kind of shortening our what we call key rate duration. Where are we getting our exposures for the diversification? Looking much more to the front end of the curve than historically you would have thought, hey, the back end is really the best place. In today's environment, I think the back end is much more vulnerable, and a stagflationary kind of outcome really changes how you think about defensive positioning in fixed income portfolios.
We were talking to Priya Misra earlier of JPMorgan Asset Management, and she said that 30-year treasuries were the risk asset right now and doesn't really want to go there. Do you feel the same?
Yeah, it's a similar viewpoint. Yeah, you got to be careful because there are a lot of cross currents. There's a lot of potential for policy intervention and some other changes. And you have to also be careful that market positioning, as Priya's talking about, it's a very popular kind of crowded viewpoint that the back end is vulnerable. That being said, I think the base case is, and we've seen it here, we saw it in the post-tariff announcement, a big curve steepening, that you do have the potential here. You know, it used to be in the zero interest rate environment post-GFC, flight to quality was a curve flattener. You wanted to own the 30-year. You know, in an earlier era, long before the GFC, we used to think flight to quality was a curve steepener, and I think we're back into that kind of environment. That makes it a little bit challenging for investors who are kind of cash limited because you don't get the same kind of return for a dollar investment. It means you need a little bit more flexibility in your portfolio toolkit to use things like futures and leverage to equate your diversification irrespective of where you are on the yield curve. And a little bit more flexibility in the toolkit allows investors like ourselves to be able to do that.
Hey, Jeff. Thanks for dropping by. Jeff Rosenberg there of BlackRock on the latest in this market. The latest on the jobs market, 177K, an upside surprise on the jobs report with an industry breakdown. Mike McKee joins us now with more. Mike, what do you got?
Well, John, looking at some of the areas where you would think the tariffs would have an impact, at least they might at some point. They haven't yet today. Retailers lost 1.8 thousand jobs, but building materials, this is a time of year when people would hire more for building materials and garden centers. They were up by 2.7%, by 2,700. And as I mentioned, construction workers were up. Healthcare and social workers, this is the category that would include some of the workers that would be laid off in terms of contractors or some of the aid programs that the administration has slashed, but they were up by 7,600. So we're still seeing people getting hired into areas in which you'd think there would be job cuts or that they may be coming at some point, but we haven't gotten there yet. Only 2,000 people listed as job losers this past month. So right now, it looks like the economy is still, or the labor market at least, is still pretty strong.
Mike McKee, thank you. Breaking down the labor market for us this morning, breaking down the commentary from the White House. Annmarie, the president, with a few things to say.
A few things to say. He's talking about gasoline. He's saying it just broke $1.98. I'm actually looking at what the national average is. It's just above $3. He's talking about energy down, employment strong, and get to the punchline, of course. He's saying this is a perfect moment for the Fed chair, Jay Powell, to lower interest rates. The jawboning, Jonathan, continues.
Stephanie, is it the perfect time for Jay Powell to lower interest rates?
It is not the perfect time. It's the opposite. The economy is running okay right now. They don't want to get ahead of this. They're going to have to just wait and see what the impact is from an employment perspective and then an inflation perspective, by the way. Inflation could be running up towards 4%.
Stephanie Roth of Wolfe Research is going to stick with us alongside Mohamed, El-Erian. The whole team is going to sit around the table to break down this jobs report with us. Just for now, though, I want to get you some top stories from elsewhere with some Bloomberg briefs. Where's Yahara Hacker? Say, Yahara.
Hi, John. Recapping that data, April payrolls topping forecast. The U.S. added 177,000 jobs, and the unemployment rate held steady at 4.2%. Looking under the hood, manufacturing jobs fell by 1,000, but transportation and warehousing added 29,000. Wages are also up year over year by 3.8%, outpacing consumer prices. We love to see that. Next up, we have China saying it's assessing the possibility of trade talks with the U.S. It's the first sign since President Trump hiked tariffs last month that negotiations could begin between the two sides. Still, as a condition to negotiations, the ministry asked the U.S. to show sincerity towards China by canceling tariffs on its goods. And the White House is set to release the first budget proposal of President Trump's second term. According to sources, the so-called skinny budget will call for $557 billion in non-defense spending, a nearly 23% drop from current levels. Meanwhile, national security funding would rise to $1.01 trillion, which is a 13% increase from existing levels. That's your Bloomberg Brief. John?
Yahara, thank you. Thanks for this morning. Up next on the programme, we'll break down this jobs report, this market, and look ahead to the week ahead. From New York, this is Bloomberg. The opening bow just around the corner. Equity futures up by 1% following an upside surprise on the payrolls report. From New York City, welcome to the program. Looking ahead into the weekend and through to next week. Coming up a little bit later, you'll get data, durable goods and factory orders. Monday, ISM services. Tuesday, the trade balance. Wednesday, a Federal Reserve rate decision and news conference with Chairman Powell. And then on Thursday, another round of claims and a Bank of England rate decision. With us around the table, Mohamed, El-Erian and Stephanie Roth. Stephanie, what are you looking for in the data into next week?
Yeah, I mean, so for certainly, well, let's just comment on today is, yeah, the economy is solid right now, but heading into the next couple of months, it's going to take a big turn. And by the way, one thing we didn't talk about yet was the foreign-born numbers within the payrolls print was a little bit softer. So this is something to keep an eye on in the next couple of months, is to the extent to which immigration is also having a negative impact on the labor market.
Mohamed, is that your worry as well, that in the next few months this data is going to weaken?
I do worry about the supply side. I don't think we pay enough attention to the supply side. And Stephanie's absolutely right. You should look at the various disaggregated data that give you some signal. Broadly, can I give a suggestion for the graphic you just showed?
Please do. What would you change?
You should have underneath, going across every single day, tariff negotiations. Because I suspect that you will be talking about that layer as much as you'll be talking about what's above.
Can you speak to the graphics department? Lisa, can we make that change next week?
So, tariff talks will happen. Tariff talks may happen.
We could have
Maybe
that run across the bottom of the screen.
It will happen. You think so?
That could run across the bottom, couldn't it?
Well, this is the issue, right? So how do you interpret these numbers and how do you extrapolate them forward? And you pair that with what President Trump just tweeted, or truthed, or whatever you want to say, which is no inflation, lower rates. Are we trying to get ahead of something? Are we just reflecting what actually we're seeing? How is the administration's response to the incoming economic data going to cloud the equation on all sides when people still believe there is a Trump put?
I love the idea of a tariff ticker because I feel like I could help with it. Two things to watch out for today. Japan, they're coming out and they're saying the U.S. is reluctant on a number of issues that they need to see to get a deal. And of course, China. The driving force of all of this, when you talk about ships being backed up, China's very important. Maybe they're ready to come to the table.
Session highs in the equity market up by more than 1% on the S&P. After the commercial break, we'll be right here. We'll be catching up with the administration, reacting to the payrolls report. Stephen Myron, the chairman of the Council of Economic Advisors.
Welcome back to another special Mutua Madrid Open update for Bloomberg TV and radio from Tennis Channel. Coco Gauff reached the championship match in the Spanish capital for the first time after she took out defending champ Iga Swiatek in straight sets. She'll face world number 1 Aryna Sabalenka for the title after she was just too good for Alina Svitolina. Coco leads their head-to-head 5-4 going in to Saturday's showdown.